as we kick you off to the close here on this Wednesday afternoon. Romaine Bostick here alongside Katie Greifeld here. And of course, there is going to be a big focus on what's going on in the markets and some really interesting economic data that we got this morning. But we are awaiting the first face-to-face meeting between the presidents of the two largest economies in the world. Joe Biden and Xi Jinping set to meet on the sidelines of the APEC summit today in San Francisco. A lot of expectations. I'm not sure we're actually going to get any sort of meaningful results.
That's the thing, of course. There's a lot of hype around this, a lot of fanfare, and it's the symbolism of the moment that I think matters more than anything in terms of concrete things that we can take away from it. Unclear, but of course, again, to have the face-to-face meeting is very important for optics.
Of course, and with a lot of folks beneath those two have really been making the rounds, trying to sort of set the stage for this meeting. Our very own Anne-Marie Horton took a flight out there to the sidelines of the APEC summit, where she stands right now as we await, Anne-Marie, the handshake that I guess will be heard around the world.
Yeah, that's right. The president took a drive from nearly where I'm standing, about 35 minutes south of the city, Romaine, and we are awaiting this meeting, the first time these two leaders, Joe Biden and Xi Jinping, will sit down with each other in a year. It's Xi Jinping's third visit outside of China this year, and this is only he hasn't been in the United States in 6 years. So it's really a high-stakes moment for both of these individuals, but to your point, Romaine, the biggest deliverable is going to be the fact that these two individuals are sitting down and they are meeting as we await that handshake. President Biden arrived at this estate outside the city about 10 minutes ago. So what we can really expect here is just hours of deliberations, and the agenda items is enormous. It's going to be when it comes to the military. We know a priority of this administration is trying to get military-to-military communications back on track. Yeah. Remember, China really ripped the cord on that normal dialogue after Speaker Pelosi went to Taiwan last summer. Economic concerns on China's front, they're going to want to press those. Fentanyl, human rights abuses. I mean, there's a number of items these two men are really going to discuss today.
A number of items, and as you said, I mean, there's a lot of distance between the two sides on a lot of those items. And this, of course, though, this face-to-face meeting follows a steady drumbeat of U.S. Officials, U.S. government officials going over and meeting with high-ranking Chinese leaders. Now we actually get the face-to-face meeting. But to your point, the biggest deliverable is that we get this meeting. Where does the relationship go from here on the other side, potentially?
It's a great question, because I'm having deja vu to the summit I attended in Bali, and these two men, Joe Biden and Xi Jinping, met on the sidelines then, and then they told their teams to get to work within each other, counterpart to counterpart, to move this bilateral relationship in a better direction. And then obviously, we saw that there's been a number of things that have happened over the course of the past year or so, notably in the United States as well, the alleged China spy balloon flying over the continent of the United States, that really just continued to hammer this relationship and make this relationship much worse. We also have to take into context what is happening around the world right now. There's a conflict in Europe and a conflict in the Middle East, and both these power players on the opposite ends of those struggles.
All right, Anne-Marie, hold that thought. Stand by. Of course, we are still awaiting to see the two heads of state from the two largest economies meeting there in Woodside, California, just outside San Francisco on the sideline of the APEC summit. We're going to check back in with Anne-Marie in pretty short order, but we do want to kick things off to the close here with a refocus on the markets, and more importantly, a refocus on some of the big investment themes. The folks over at Blackrock putting out their outlook here for some of the big themes for 2024. Pleased to say that Jay Jacobs, the U.S. head of thematics and active equity ETFs at Blackrock, joining us right now here on Studio 2 at our Bloomberg World headquarters. Jay, first of all, welcome back. Great to have you back here in the fold here. I'm sure you're really eager to get back to work. Let's start off here with the outlook for 2024 and the big themes. And I assume that one of the big themes that's going to carry over from 2023 is artificial intelligence. Am I wrong?
Absolutely. It's only been a year since ChatGPT came out, and it feels like the whole world has changed, especially in the AI and the tech space. And what the market's really focused on in 2023 were the Magnificent Seven mega cap tech names that are leading in GPUs and in AI platforms. But it's really missing a big part of the AI stack, like digital infrastructure, CPUs that are going to be powering AI inference, as well as the applications that are built on top of these AI platforms. If you go backwards, 4G was an incredible platform technology for things like e-commerce and social media. AI is another platform technology that's going to create entire industries that maybe don't even really exist yet today.
I'm glad you say that. One interesting thing that I saw at the report, and it was almost like towards the bottom, I almost felt like you should move it up to the top, but it was about this idea that if you were looking to really sort of harness AI as a theme, and even some of the other themes that you point out there, such as the growth of India and others, that you're not necessarily going to find those opportunities in the Magnificent Seven or in that small cohort of tech stocks, that there's a much broader universe of names that'll benefit that folks need to start paying attention to.
Yeah, absolutely. So most of the really pure play thematic names and things like AI or biotech or in some of our emerging market picks like India and Mexico represent less than 2% of someone's portfolio. So if you want to overweight and really try to narrow, kind of zoom in on some of these more powerful growth opportunities, you have to intentionally overweight these sectors or these themes using things like thematic ETFs that can give really targeted exposure.
And it was interesting to read that because right now when someone says healthcare, when they say medical innovation, I mean, I just short circuit and go to GLP-1s. It seems like that is really the theme of the moment. How is BlackRock and your thematic group thinking about GLP-1s and just weight loss drugs in general?
So we really look at it in the context of a major demographic shift, which is aging populations around the world. In the US in 2024, it'll be a landmark year where there will be more 65-year-olds than people under the age of 15. If you go back 100 years ago, there were 6 times as many people under the age of 15. So this is a major landscape shift. And what that means is it's going to put a lot of demand on the healthcare system, especially for age-related diseases. That could be neuroscience-related diseases like Alzheimer's and Parkinson's, but also weight loss drugs like GLP-1, which could reduce heart disease, that could reduce diabetes, other ailments that disproportionately impact seniors. So we're really thinking about it in the context of this major demographic shift for aging populations.
Well, Jay, on that note, I'm kind of focus grouping an idea in live television, I guess, right now. Basically, if you take the Fed out of the equation and you take a look at the stock market in 2023, it feels like the two themes that have really driven basically the indexes has been AI and it's been GLP-1s. Again, taking the Fed out of the equation, which is difficult to do. Does that hold water?
I think it does, and frankly, those themes have succeeded despite the Fed, because most people would say technology stocks and healthcare stocks, especially biotech stocks, would be impacted by rising rates, and that's not what we saw in those specific areas. But when we focus on for 2024 is really what's the next phase? What's the next phase for AI? We think that's going to be a broadening of commercialization beyond those Magnificent Seven. And when we look at healthcare, it's not just, GLP-1 is important, and we'll see more commercialization of that. We'll see broader adoption. But I would really look towards those neuroscience names as well, as we see Alzheimer's and other age-related diseases becoming more prevalent.
I'm curious also, there were a couple other things that were in this report, and it also kind of talked about just the idea of cash and the short-term investments that so many people have gravitated to here. Do you see that trade really being unwound in a meaningful way?
So there are records amount of cash on the sidelines, $6 trillion in money market funds. So clearly investors, at least this year, have said, I'm happy getting around 5% yield and not taking on equity market risk. We think that's a mistake. For longer term investors, you want to participate in the growth of the markets. We see opportunities, but you really have to get more narrow. If you simply look at the broad market indexes, you're capturing a lot of exposures and maybe not, some of the highest growth opportunities. But if you look at healthcare, you look at AI, you look at some emerging market opportunities, then you can get more narrowly focused on growth.
But the idea also in the report, and I think you used the exact word, something like the bar is higher for how you evaluate equities in light of the fact that, like I said, I mean, if you can get 4 or 5% here, that in a relatively risk-free asset, that changes the dynamics of what you're going to pay for the risky of assets, which are often equities.
Absolutely. So you either want higher growth rates or you want cheaper valuations. And if you look at biotech stocks, that's kind of an interesting area where you have high growth and low valuations, because frankly, just biotech has not done very well this year beyond the GLP-1 drug makers. But maybe one of the best intersections of growth and valuations is emerging markets. And so we specifically highlight areas like India and Mexico as emerging markets. They have attractive demographics, they have higher growth rates, and as you look at the changing supply chains around the world, these have become really critical partners of the United States. Just in the last quarter, Mexico became the biggest trade partner of the United States.
Yeah.
And so, I mean, just zooming out and thinking about thematics, obviously we're talking about a lot of really exciting ideas. We've seen obviously that play out in some of the stock prices this year when we talk about some of these themes. But when we think about thematic investing through the lens of ETFs, it just feels like you haven't seen the same appetite to go into these products despite outperformance in many cases. And I'm wondering about how you're thinking about that over at BlackRock.
So we have a lot of tools for people to express a thematic opinion. Yes, we have thematic ETFs that are built from the bottom up to capture something like AI with our IRBO ETF, but people use subsector funds like semiconductors, SOXX. They use country funds like Mexico and India to play these thematic trends that we're seeing around demographics and AI and healthcare. So there's really a lot of tools for investors to use. Thematic ETFs can be great for capturing more nuanced themes in an entire value chain, but it's not limited to just those ETFs to play things like demographics.
And Jay, of course, we're having this conversation as we await that face-to-face meeting between Joe Biden and Xi Jinping. And I'm looking through your list right now. You also highlight the rewiring of globalization as one of your key trends to watch next year. Walk us through that.
Well, look at the industrial policy we've seen in the United States. The Chips and Science Act to build more semiconductor manufacturing in the United States, the Inflation Reduction Act to build more things like electric vehicles in the United States. We are trying to domesticate more production, but also we need to rely on trade partners to be able to do that. And so if you look at areas like Mexico, which have historically been great trade partners with free trade, lower cost of labor, if you look at India, which has incredible demographics, and we're reducing tariffs with India right now, you're just seeing more cross-border trade with some of these individual countries.
All right, Jay, always great to talk to you. Jay Jacobs, the U.S. head of thematics and active equity ETFs over at Blackrock, helping us kick you off to the close here on this Wednesday afternoon. Now, we do want to go back out to California, where the heads of the United States and China are set to meet face-to-face for the first time in just about a year. This on the sidelines of the Asia-Pacific Economic Cooperation Summit taking place in San Francisco. Anne-Marie Horton on the ground out there in San Francisco with a member of the Joe Biden administration.
Thank you so much, Romaine. Yeah, as we wait for President Biden to sit down with Xi Jinping, as you've noted, the leaders of the two biggest economies, they're also the leaders of the two largest consumers when it comes to energy in the world. And I'm now joined by Amos Hochstein. He's a senior advisor for the President of the United States. He's also been known to be called his energy czar. This is one of the spaces you play in when you advise the president. Amos, when you take a look at what's going on in the world, we have Iran, Russia, Venezuela, all exporting more oil under the Biden administration. Is it a fair assessment when you look at this landscape that you just want to see the oil flowing?
Well, Anne-Marie, first, thank you for having me here during a busy APEC. Look, when I was on the show just a couple of months ago at the end of September, most of the market was being quoted as saying prices were going to $100. There was no stopping it. Today we're at $81, $82 in Brent, and then WTI is in 77 or so. And I think what we've been trying to do, what President Biden's been trying to do, is to do two things at the same time that people didn't think we could, which is accelerate an energy transition and put more money into the system, more tax credits through the IRA, the CHIPS Act, and the Infrastructure Act, while at the same time ensuring that we have enough oil and gas on the market to sustain an economic growth. And that's what we've been trying to do. I don't think Venezuela has really grown in its exports. I think that it's been relatively steady and at a very low point from where it was. Today it's at about 750,000 barrels a day compared to maybe over 3 million just 20 years ago. So we've been trying to make sure that we can have a price that makes sense for the American consumer and around the world to support economic growth and reduce inflation. And I think that's been rather successful. Very difficult to do when you have a war in Russia and now a war in the Middle East.
Well, you just got back from the Middle East. You were in Lebanon, and your message there, according to the Arab press, was to make sure that this conflict does not spread, especially along with Hezbollah in the southern Lebanon border, northern Israeli border. How concerned are you after that trip to the Middle East that this will spread? Because also that's a key concern for the oil market as well.
Well, as you said, I went to Lebanon last week. From the beginning of the events in the Middle East, after the horrific terrorist attacks by Hamas on October 7, and the war started, we wanted to make sure it's contained there and does not become a Middle East war. And there's been a lot of exchange of fire between Israel and Lebanon, between Israel and Hezbollah, I should say, and the Palestinian terrorist groups that are based out of Lebanon. What we don't want to see is an expansion and a creation of a new front in the north that will inflame the region and carries with a lot of risk. I will tell you this, across the board in Lebanon, the people, the government do not want the war in Gaza to expand to Lebanon. And I think that what you're seeing in the markets actually is pricing in a success of the Biden administration policy of trying to contain it. Now, I'm not going to say that we've succeeded. We've succeeded so far. This is a dynamic situation. So, yeah, I took the extraordinary step to go to Lebanon just for a few hours to meet with everyone there and assure everyone that the United States does not want to see this expanding. That is our message to Hezbollah. That is our message to all players in the Middle East, not to expand this war and not to take advantage.
When it comes to Lebanese Hezbollah, when it comes to Hamas, they are backed financially by Iran. And what we've seen over the course of the past few months, especially in August, from outside analysts like Tanker Trackers, is that Iran is exporting much more oil under this administration. You ask the Treasury Department, they say they're enforcing sanctions. Is the U.S. actually enforcing sanctions, or are they turning a blind eye?
We are enforcing sanctions. You saw over the summer period a significant destocking or selling off of tankers on the water. Not an increase in production as much as letting out some of what was in storage. I think those numbers have come down since then, the exports out of Iran. And I think the best antidote to revenues in Iran is keeping their exports at a lower level, but also to make sure prices are lower because we have that interplay between volume and value. And so what you're seeing the price today, Russia, as far as the price cap is concerned, and Iran and Venezuela, when the price comes down to roughly $80 from just 2 months ago it was at 95, and today it's at a much lower rate. That allows American consumers to have lower gasoline prices, and it allows us to make sure that some of these actors that you've mentioned around the world don't have as much revenue.
So it's lower oil prices, but at the expense of Russia still being able to, Putin still being able to make money. There's a lot of reporting that he is actually outside the price cap. Iran is selling so much more than they ever have been. 90% of that going to China. This summer, they were at nearly more than 2 million barrels a day of exports. Do you think that there needs to be a more concerted effort to go after individuals who are moving around the U.S. sanctions?
So one, let's just level set a little bit. Iran is not exporting more than they ever have. They exported over 2.5 million in 2012 before the sanctions hit, enforcement of sanctions during the Obama administration. It rose again after the JCPOA and now when the implication of sanctions. I don't think they reached 2 million barrels a day. They were exporting at somewhere in the elevated area above 1 million barrels, but not quite as much as 2. We are going to enforce the sanctions. Those numbers will come down. And we will do that in a manner that both allows the value and the volume for Iran to reduce. As far as the price cap, look, we set it at a certain price. It worked for several months. There's been a little bit of an increase in Russian sales, kind of dovetailing with the overall increase, massive increase in price of oil when it reached $95. That's come down, and with it, the discount between euros, the Russian euros, and Brent. So I think we're gonna go and take more measures on this.
All right, Amos, we're going to leave it there. President Biden and Xi Jinping are handshaking now. Romaine, Katie?
All right, well, right now watching President Joe Biden and President Xi Jinping of China there shaking hands, getting out of the vehicles, walking into, of course, that historic mansion there in Woodside, California, just about 25 miles south of San Francisco. On the sidelines of the APEC summit, the leaders of the world's 2 largest economies meeting face-to-face for the first time in about a year's time. A long-awaited meeting by a lot of folks, a lot of watchers here who really want to see, Katie Greifeld, a bit of a thaw in U.S.-China relations. Of course, the groundwork for this has really been done by a lot of the deputies of both of these men, including Janet Yellen, as well as a few key players here on the U.S. government side, really trying to lay the groundwork here for not only what these 2 men can talk about, but whether there really is going to be any common ground that they can find that will move this relationship forward.
And you think about this moment in time, of course, both when it comes to the global economy, but also geopolitics as a whole. You think about the fact that there's a hot war in Israel right now, the Russia-Ukraine conflict as well. And you think about, the 2 leaders of the 2 most powerful economies in the world. Hopefully there is some common ground to find.
Yeah, it'll be interesting, too, because the list of things that they have to talk about, it is like the proverbial laundry list. It is long and it is deep. And most of these things, at least on the U.S. side, we know aren't things that Joe Biden himself can just flip a switch and promise. A lot of these things would either have to go through Congress or through regulatory agencies here. So he not only needs to get the buy-in from China on anything, but he's got to get the buy-in by the American people as well.
It's a great point that you think about, again, some of these issues, they can outlast a president. For example, you think about what's happening in the semiconductor industry. You think about trying to basically diversify your supply chains away from China, away from Chinese factories. That is something that takes years, if not decades. So a lot of long-standing issues to go over here.
And then, of course, there's a lot of the military issues. I'm sure it's going to be a topic of conversation with regards to Taiwan and China's approach to that, particularly in light of what happened, of course, with the war in Ukraine and now, of course, the conflict in the Middle East and China's positioning on that and whether that's going to be, I guess, enough to the liking of the U.S. government in order to accommodate them on some of those issues.
And of course, you think about this moment in time for China and the struggles that they're having with their economy right now, and the idea that China, of course, it wants to keep foreign investors coming into China, investment coming into China. You would think that normalizing relations with the U.S. would probably be a good sign to the global investment community there.
Absolutely. Well, it has to be, right? I mean, look, you can talk about decoupling all you want, but the two largest economies in the world are never, well, I should say never, but they're not going to decouple completely. I mean, you can maybe sort of trim some fat around the edges, look for a way to manufacture some stuff closer to home, or maybe move it to other parts of Asia or even into Africa. But you're not going to do that in a wholesale way. And then there's a whole idea of selling there. I mean, think about how much presence certain companies have over there, whether it's Tesla, whether it's Apple, whether it's names like Procter & Gamble, whether it's a lot of the pharmaceutical companies here. That's not just pack up and go home and leave behind 1 billion plus customers.
Yeah, and I mean, Apple is such a great example of the delicate dance that basically these global companies have to do, based in the U.S., but really global in nature, at the same time that Apple is trying to diversify its supply chain, trying to rely on China less. You think about where iPhones are sold. Obviously, China is a huge, important market for them. And at a smaller scale, that's something that a lot of global companies are trying to grapple with.
They're trying to grapple with, and that brings up the whole issue, too, about this technology and the idea that there's always been these fears, some well-founded, some maybe just speculation, that a lot of this, the technology that we're producing in the U.S., meaning the design, and then, of course, the structure of that, which gets built in China, and that some of that sort of know-how is now being siphoned off so that China can make their own things without necessarily compensating those companies for that. They've been going back and forth on this for years now. And I don't know how you resolve that, particularly given China's ambitions to become more self-sufficient on its own technology rather than having to rely on the U.S. and, for that matter, European companies, but also the U.S. companies themselves that have found some sort of symbiosis in that relationship, but that's been completely upended.
Absolutely. Again, just one of the many things that's really feeding into this conversation that's going to happen between these two men, the global community really watching. And it'll be interesting, too, to see what happens if there's any conversation around India. We know that one of the big themes this year has been India's rise, obviously their population boom as well. There's a lot of really bullish hopes pinned on India right now, and you have to imagine that's one of the topics of conversation here. Maybe not necessarily between Biden and Xi Jinping, but you think about the people attending APEC right now, has to be top of mind.
And we talked a little bit yesterday, too, about all of the business leaders who are, of course, lining up to try to get some face time, if not with Xi Jinping himself, certainly with one of his deputies here. And it's the usual suspects, right? I mean, these are the global companies that we talk about here in the U.S. here that either have a large presence in China and Asia, or at least want to expand that presence in China and Asia. And so they've got to play ball, too. And so they need to find a way to sort of navigate U.S. politics and at the same time navigate, I guess, some of the potential risks of getting in bed with Xi Jinping.
Yeah, that's true. A lot to consider there, especially too for President Biden. Of course, this comes at an interesting time for him. We're about a year away from the election. I don't know if you've been following that.
I've heard we're going to have an election. I've heard it could be potentially contentious.
Yeah.
One interesting stat, though, that it's a lot of people have made hay of this idea that Xi Jinping is basically there for life, more or less there, but in the time that he's been in office, we've had 3 separate U.S. presidents during his reign, and it's certainly plausible that maybe in the next year we could have a different U.S. president here in the U.S. So you think about the continuity in leadership in China and the lack of continuity that we have here, and I wonder how much that complicates things. Like if Biden makes a promise that might take months, if not years, to actually see through, how can he sort of make that commitment if he can't guarantee to Xi Jinping that he's actually going to be in charge come the start of 2025?
I mean, it's a great point. It goes back to, you think about some of these long-standing issues, that outlasts the president. It doesn't necessarily outlast Xi Jinping. And I mean, you think about some of the people who are vying for President Biden's seat. Former President Donald Trump obviously has taken
some of the people vying for. I think there's only one person
theoretically
vying for it right now.
A long list.
Yeah, there's a long list.
Donald Trump,
but as far as the ones who are actually, not like 50 basis points behind on the polls.
Exactly. Yeah, but obviously, the Joe Biden administration approach to this relationship is different than the Donald Trump approach to this relationship.
So we're dancing around. We're talking about all these important issues, and look, they're certainly important. You have not mentioned the pandas yet, and I told you this last time, Katie, that if you want to really thaw relationships, wouldn't it just give us the pandas back?
I know.
I mean, it's such, I don't know.
I know that
I know this was kind of pre-planned, that they were always supposed to at some point go back at some point, but I don't know, to take them back right now,
I know that we're joking about it, and I know that a lot of people are,
I'm not joking about it. I was in D.C. when the pandas first arrived, and they were trying to get them to mate, and they had the camera over their bed effectively here, as we're trying to watch, sort of what happens. And, it meant a lot. I mean, it meant a lot, I think, to the American people, not just as the gift from China, but just the idea of the joy that it brought us, and for them to steal that joy.
I mean, maybe it's being discussed right now. You take a look at that table, of course, a live shot of this high stakes meeting that we've been waiting for. Of course, the first face-to-face meeting between Joe Biden and Chinese President Xi Jinping, in a year, I believe, is the size and scope. I believe I glimpsed sight of Treasury Secretary Janet Yellen there. But as you can see, Romaine, that meeting is well underway.
Yeah, you can see Anthony Blinken there, and I believe John Kerry there in the background. Of course, this is taking place, very beautiful property. I've never actually had a chance to actually go Fioli. I'm not too familiar with it firsthand, but it is this sort of largest historic mansion just south of San Francisco, out in Woodside, California. So an interesting setting here to bring Xi Jinping rather than maybe keep him, I don't know, in some convention center in downtown San Francisco.
We haven't even talked about the significance for San Francisco. A
this
city in decline, many have called it that.
Yeah, this is a big deal, and we've spoken with some business leaders already, and I think we're going to speak with some a little bit later on the program who are still committed to the city. They say, look, don't buy into the hype that we're a city in decline. They're having problems, but they feel like, there's still a core there in terms of business, in terms of just the minds, the people who live there, and the talent that you have. And it'll be interesting to see whether this APEC summit actually provides a bit of a shot in the arm for that summit. All right, we're going to be all over the APEC summit there as Joe Biden and Xi Jinping meeting face-to-face for the first time in just about a year's time. This is The Close. Romaine, Bostick, and Katie Greifeld. This is Bloomberg. Welcome back to The Close. President Joe Biden and President Xi Jinping, the leaders of the two largest economies in the world, meeting for the first time, a highly anticipated face-to-face meeting, their first face-to-face meeting in just about a year. This comes on the sideline of the APEC summit taking place in San Francisco. The President, Joe Biden, and President Xi Jinping meeting just outside San Francisco, about 25 miles south at a historic mansion there in Woodside, California. Obviously, the laundry list of topics that they have to discuss, the laundry list of problems that they need to solve, of course, probably isn't going to get it worked out in just one day. But the groundwork for this meeting has really been laid by the people that you see alongside them. Some of Xi Jinping's deputies there, both to his left and to the right, and of course alongside Joe Biden, Secretary of State, Secretary of the Treasury, John Kerry, and quite a few other folks also there as well. This is obviously just going to be the start of negotiations that will have to get a little bit more into the weeds that, of course, the presidents themselves won't necessarily themselves get into. Pleased to say, for some more perspective here on the ground of what's taking place at the APEC summit, we're joined right now by Al Kelly. He's the executive chairman over at Visa, and he is there at the APEC summit in San Francisco. And Al, first of all, appreciate you being here on the program today. I do want to start off here with the summit. You actually had a chance to actually take the stage here at the opening ceremonies for this summit. Give us a sense here of the mood, of what people kind of expect to accomplish, even beyond just the big meeting between Xi Jinping and Joe Biden.
Romaine, it's great to be with you. Look, this is very important for the city of San Francisco. The city's had some issues over the last number of years in recovering from COVID, and I think this is a real positive shot in the arm for the city of San Francisco. And this city has a lot of energy, more so than I've seen probably since the beginnings of COVID. And I think there's a lot of a sense of hope. Hope that discussions, not only between China and the U.S., but discussions amongst the 21 economies that are represented here, will lead to various breakthroughs in terms of helping small businesses around the world, driving increases in digital trade and digital enablement. So I think it's a very, very positive mood so far in terms of what I've seen.
I have to ask you about your expectations with regards to the relationship between U.S. and China, and whether this meeting that we're all obsessing over could actually produce some sort of material result, some sort of material improvement, I should say, in relations between the U.S. and China.
Well, I'm not in the room, but I can tell you this. I think there's no substitute for dialogue. I'm thrilled that the two leaders and their key folks around them are getting together and talking. I don't think it's realistic to think on a 4-hour meeting you're going to solve all the problems of the world, but I think that it is a very, very healthy sign that they're sitting together and will touch on various levels of discussions. And my hope is that this becomes a jumping off point for more and more dialogue on specific issues amongst the most appropriate and relevant people in each administration to get together and see if we can make progress. But there seems to be a sense of hopefulness and energy that I'm feeling in terms of this meeting that just started to take place about 20 miles south of me.
And Al, of course, Visa did make some news at this conference. I'm reading a press release from this morning that Visa is basically accelerating its support for small and micro businesses when it comes to both the APAC region and globally. Could you give us some context there? What countries are we talking about when we're talking about this support?
Well, the countries we're talking about were the U.S., Mexico, Peru, the Philippines, Vietnam, out of the chute, Indonesia as well. Those are the initial areas of focus. And Katie, the announcement we made today really had 3 parts to it. One is we're making a $100 million pledge from the Visa Foundation to help underserved and women-led businesses in the APAC economies. Secondly, we announced that a goal we set in 2020 to digitize 50 million small businesses and micro businesses around the world, that we've significantly exceeded that, and we've reached 67 million businesses that we've helped digitize. And thirdly, we're not done. We announced today a small and micro business accelerator program where we hope to take many, many more small businesses around the world and help get them digitized. As I think you well know, small businesses are the backbone of virtually every single economy, not just in APEC, but around the world. They're very, very important in terms of employment. They're very, very important in terms of creating real Main Street hubs in communities in which we live, and they're just very important to the economies of these countries.
And now looking through the statement, you make the point in it that if over the last 3 years, you've really seen small business harness the basically digital payments. And given that you are speaking to us from APEC, talk to us a little bit about the cross-border payment ecosystem and how that's evolving right now.
Well, I think that data is a very, very important fuel around the world. And what happens if you can digitize payments, you can actually open up the world to small businesses beyond just the village that they sit in. If you can have a website and expose your products beyond that little village you live in, you just have a greater opportunity to reach more of the world. But digital elements that come into place in countries are becoming increasingly important. Governments are realizing that if they can give out their subsidy programs and via digital means, it's much better than vouchers. It also creates more transparency in the collection of taxes. We're working very closely with transit authorities around the world, 700 of them, where if we create open loop payment systems, it makes it a much greater and better experience for the consumer and a much more operationally efficient for the transit authorities. So, and then I think in general, that whole point about opening the world to a greater audience of consumers, all of these things happen when digitization of payments, both domestic and cross-border, are accelerated around the world. And it's something that we certainly are talking to many of the participant nations and economies about.
Well, Al, we really appreciate you taking some time for us. Our thanks to Al Kelly. He is the executive chairman of Visa. And of course, Romaine, it looks like we are getting some headlines out of that face-to-face meeting between Joe Biden and Xi Jinping. Xi Jinping telling Biden that it's unrealistic for one side to remodel the other, also saying that turning their back on each other is not an option for the U.S. and China. All
right. Well, we've kind of heard that before from them. Of course, we'll continue to keep an eye. And maybe if we do get any sort of detente here, of course, that could be potentially a net positive here for the market, which I think definitely wants to see not necessarily a complete reconciliation between these two U.S. economies, but at least some consideration that they can continue working together.
Yeah, normalization is the name of the game. But speaking of markets still ahead, we're going to talk about retail stocks. They're rallying today, but TJX is the worst performer on the retail index after posting lackluster projections for the current quarter. We'll recap those results next. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Bristol Myers Squibb. The drug maker cut to neutral from overweight over at Cantor Fitzgerald. The analysts there are calling it a value trap, saying the cons simply outweigh the pros for being a cheap stock and suggest launching new products to restore investor confidence. That confidence, though, well, investors still have it, up about 2% on the day. Next up, let's take a look at VF Corp. JP Morgan upgrading the parent company of North Face and Vans to neutral from underweight, with the analysts praising the new CEO's plans for improvement through 2025. He says the turnaround plan can reverse that multi-year risk-reward profile. Shares of VF Corp having a pretty good day, up about 15%. And finally, American Eagle getting a new rating at neutral over at Bank of America, with the analyst seeing near-term revenue momentum driving up consensus estimates. He also cites some upside from that area unit that has actually been outperforming, and says the business overall is in the early innings of a cost revamp. Shares up about 5% on American Eagle, and those are some of our top calls. We do want to say in the sell side space, and we want to stick with retail. We did get earnings this morning out of TJX, and the company saying it's off to a strong start just after posting a third quarter results this morning. The off-price retailer lowering its fourth quarter projection for profit, which some analysts say is a bit conservative. Let's bring in Adrienne Yih. She's a U.S. retail senior analyst over at Barclays, still has an overweight on TJX. And Adrienne, let's just start off here with why we're kind of seeing the negative market reaction, because when I looked at comp sales in the quarter, they were pretty much a beat all around. And even their guidance on comp sales going forward, we're still kind of at the high end of what investors were expecting. Is this about sales growth, or is this more about margins and profitability?
It's about positioning, in fact, right? So TJX and the off-pricers have been the defensive trade. And I think the juxtaposition of Target printing today and having big kind of upside from that clean inventory and that margin recapture is kind of making people think that, hey, there's a beta trade, right? There's a higher risk reward trade that could be happening as we enter 2024. I know you've been on before kind of talking about the cleanliness of inventory at frontline retail. And if you think about it, TJX has been the outperformer. 2022 was their big outperforming year. And this year, we're starting to see that fundamental flow through. So I just think that this is purely positioning, and they are notoriously conservative when they give that guidance. But you're absolutely correct. They are comping. And that's a big difference than most of the retailers that are out there today.
There's a broader question here just about kind of these off-price retailers. And TJX has always been one of those companies that has kind of been seen as sort of recession-proof. The idea that people go to them when times are good, and of course when times are bad, they go to them even more. When we look ahead to some of its competitors or its peers out there, like Ross Stores, which I think might report tomorrow evening, are we going to see more of the same out of those names, or is there something specific to TJX and its properties that we should be focused on?
So the off-price model itself is actually having its golden moment, right? It's prime time for that kind of defensive posturing. Ross Stores will report tomorrow night, as you said. they tend to focus on a 50,000 household income. TJX tends to be at 75K. And then next week we'll get Burlington. I think you're going to see a very, very similar report, similar to the good, right, that we saw from TJX. And I think that Burlington next week is going to be a little bit more, it's going to be tougher, right, because the first two kind of are taking up all this good inventory. And we know that Burlington sort of has been struggling with their business model to really take advantage of what's actually happening in the marketplace.
And Adrienne, talk to us a little bit about how important the holiday season is for these retailers in particular. I know it's very important across the board, but when you think about the off-price retailers, how much does this matter?
This matters hugely. You know, NRF came out with their holiday forecast sort of in that 4%-ish range, you know, give or take. That's really healthy, right? And what we're seeing from the consumer is that they are seeking value. They are trying to stretch that dollar. Their wallet is very much under pressure. And the off-price channel is delivering that value, you know, greatly, right, across all these different categories. So I really do think it's going to be the off-price holiday. And the second thing that I'll say just about the consumer behavior, it's very pockety, meaning that on the kind of, you know, high traffic days that she should be shopping or he should be shopping, they're out in force. On the kind of days that there's nothing going on, October, kind of the shoulder periods, you're going to see a big quiet lull in the early part of December after Black Friday. That's when it goes really, really quiet. So when they come out, we absolutely think broadly they're going to come out for holiday, but mostly they're going to, you know, off-price is really going to win this holiday season.
All right, Adrienne, always great to talk to you. Adrienne Yih over at Barclays. A closer look here at some of the retailers that have been reporting earnings, including TJX, which came out earlier today, and Ross Stores, which is scheduled to report earnings tomorrow. A lot more coming up here on the big program as we count you down to the closing bells. A conversation up ahead with Dr. Lloyd Minor. He's the dean of the Stanford School of Medicine, and he sat down with David Weston to talk about how physician scientists envision using artificial intelligence more in their practices. That conversation coming up after the close. After the break. This is The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, there's been so much focus this year on artificial intelligence. And let's get beyond the hype here and really start to talk about how this stuff is actually going to be applied.
And specifically in the medical area, the healthcare area, we talked with Dr. Lloyd Minor. He's the dean of the Stanford School of Medicine about this subject. He's given a lot of thought. He thinks it's a transformative moment for medicine and healthcare.
I think the transformative aspects of generative AI can be broken down into several categories. One is making healthcare delivery more efficient and effective and equitable. Efficient in that physicians, other healthcare providers will have access to information in real time and in ways that actually inform decisions about the care of individual patients. Effective in that hopefully we'll eliminate a lot of unnecessary testing, a lot of procedures or activities that don't directly link to the well-being of the patient, and equitable because it'll provide access, particularly access to specialty services that today are not widely distributed in our country and certainly in the world.
I wonder about the distributional aspect of that, of the delivery that you refer to, because there is an issue in this country that not all people get equal access to healthcare. We certainly saw it during the pandemic. Is this an area where AI could make a particularly disproportionate contribution to the healthcare system?
Yes, David, I think it really is an area where it can have a disproportionate favorable effect. So we know, for example, an example I like to draw is in dermatology. There are dermatologists certainly in big metropolitan areas like here in New York, but there are certain regions of the country that don't have dermatologists or that have them and they're so busy that it's hard to get an appointment. Our computer scientists working with our dermatologists developed an algorithm that will, from a picture taken of a skin lesion, can as accurately make a diagnosis of whether or not that's cancer or not as a trained dermatologist looking at the same lesion. Now, the dermatologist does better when they're actually examining the patient than just a picture. The point is that offers the opportunity for a physician in rural America that may not have access to a dermatologist for a couple of hours away to be able to accurately screen a lesion and know whether or not that patient needs to see a dermatologist or not.
Which may lead to a critical distinction. You have a doctor involved in all of that. It's not that generative AI replaces the doctor. It's not substitution for the doctor, but augmentation allows the doctor to do a better job faster and more broadly distributed.
That's right. And when we started deploying AI in the interpretation of radiology images, which was several years ago, 5, 6, 7 years ago, there were rumors going out that there weren't going to be radiologists anymore. And that was, of course, false. And I think there will always be a need for radiologists. And there will be radiologists who know how to use AI and do deploy it in their practices. And there will be those that don't. And in the end, those that do and use it responsibly are going to provide the better care and be able to deliver care more effectively.
We've been talking about delivery. Let's talk about another aspect of healthcare, and that is actually the underlying services, and particularly something called synthetic biology, which you have talked and written about. Tell us about synthetic biology and what that could do to healthcare.
Synthetic biology refers to engineering life. It involves taking a cell, altering it to do another function. And already today, we're using synthetic biology, for example, in therapies for cancer, where we engineer a person's own immune system cells in order to attack cancer in ways that those cells wouldn't otherwise be able to do. But in the future, we'll be able to engineer life to do other things as well. It can have enormous implications in sustainability, for example, where we may be able to engineer life to do better carbon capture or make microorganisms that dissolve plastics. But with this opportunity to change cells, to alter their metabolism, their gene expression, goes the opportunity to really rethink problems that we haven't been able to confront in the past.
What you're describing is a very different world of medicine and of research, for that matter. You were dean of the Stanford Medical School. How does this change how you train the next generation of physicians and, for that matter, research scientists?
I think it's going to have a radical effect on the way we educate physicians, physician scientists, and scientists. When an institution like Stanford, when we have the privilege of working with students for 4, 5, 6, how many other years, we're actually trying in our training programs to prepare them for 30, 40 years of productive life after that. So we're training learners more than we are imparting facts of the moment or knowledge of the moment. Generative AI, large language models, particularly as they incorporate other representational data like images, that radically changes the type of knowledge and ability that people being trained today need to have. There's less emphasis. There will be less emphasis on memorization, more emphasis, I think, on truly understanding, and in particular, understanding what these models are doing and how they can be responsibly deployed and trained.
If you were going to guess, do you believe generative AI in the end will make medical practice more attractive or less attractive to young people coming into the field?
Well, I hope it makes it more attractive, because the more that we can responsibly deploy technology in the delivery of health care, the more we should be able to get physicians and other healthcare providers back to what they really want to do, and that is interacting with patients during critically important moments in their lives. Unfortunately, in the past, technology, when it's initially implemented, has oftentimes been a barrier to healthcare providers interacting with patients. I think those barriers are about to be dramatically lowered because of the improvements in the technology.
The world you describe is an attractive world, a lot of benefits from generative AI. Where are there risks? There are always risks with any powerful tool.
There are many risks. And, you know, a couple of weeks ago, the Biden administration published an executive order on sort of the future of AI. And a key component in that statement is a focus on patient privacy. We absolutely have to keep that in mind. And that also means data security, which is linked to AI and other developments in technology. We also have to keep in mind that these models are only as good as how they're trained, the data used to train them. And if that data is biased, then the outcome, the predictions of the model is going to be biased as well. So those are some of the risks that we have to keep in mind. I think we can responsibly manage, I think we have to responsibly manage those risks, but first comes the awareness of what the risks are.
That was Dr. Lloyd Minor, Dean of the Stanford School of Medicine. I don't know about you, Romaine. I found it pretty encouraging. It sounds like there's good stuff that could come out of this.
Well, that's what I'm waiting for here, because, I mean, so much of the hype around AI is just that hype, or it's about how you can sell me ads or something. Like, give me something practical and useful to my life.
Yeah, make you healthier. That'd be a good thing. Well, tomorrow we're going to go back to the Middle East to talk to Dan Senor. He's the author of the brand new and timely book, The Genius of Israel. And then on Friday's Wall Street Week, we'll be joined by Larry Summers, former U.S. Treasury Secretary. That's coming up Friday at 6 p.m. New York time.
And David Weston joins us every day around this time for our Wall Street Week Daily segment as we round out into the final hour of trading here on the close. A bit of a mixed market here, coming off what was one of the most phenomenal days for U.S. financial markets all year long. Stocks are holding on to modest gains here on the day. That's largely on the back of an encouraging retail sales report that, while it did show contraction, it also showed resiliency. That conversation and so much more coming up after the break. This is Bloomberg. It's about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
How about those pandas?
How about those pandas? You take a look at the market today. It's not too much more exciting, so maybe we should talk about pandas.
I know. I think I would like to see them roll around in the hay or whatever they roll around in and look in this market. Look, there is some green on the screen, Katie Greifeld. So, I mean, obviously, coming off of yesterday's monster day, 0.3% on the S&P 500 is like complete snooze fest. It's like, okay, who cares? But we talk.
I mean, I was going to say, compared to the halcyon days of yesterday, we did get more data today that sort of continued the trend of inflation coming down. Maybe soft landing bets coming in. It's not boosting the S&P 500 too much, though.
Yeah, not too much here. You see Dow Transport's getting a bid here. And I think this is interesting, too, because when we talk about the breadth that we saw yesterday, whether not just the rally would continue, but whether that breadth would continue, still seeing a lot of bids coming in to transport cyclicals and some of the small cap names as well. I want to flip up the board here because one interesting story that I thought, maybe this is a bit of a lagged effect from yesterday here, but take a look at the MSCI Emerging Markets Index, which right now is up 2.5%. I mean, it only rallied about 0.7% yesterday. So, like I said, this might just be kind of that lagged effect of, remember, a lot of the names in this index are traded overseas and not necessarily here in the U.S. So this maybe is just a residual of that, but having its best day going back to November of last year. And I was taking a look at the correlations with what this chart shows you. The blue line at the top is the dollar. You can see the inverse correlation there between the white line, and down at the bottom, that's the correlation that you're actually seeing when it comes to yields themselves here. Once again, a negative correlation, so that big drop that we saw yesterday certainly had a big upside push on EM stocks.
I gotta say, correlation charts are my favorites.
Yeah, me too. I like them. I feel like we should have more correlation charts.
Yeah, it's red, it's green, it's really great. I will say, though, that the bond market's correlation to pretty much everything has been really funky lately. Interesting to see it against EM. Let's talk about some U.S. Stocks right now, because we are still...
Are these panda related?
Not panda related. They're related to the retail space, though. That seems to be the theme of the day. And it's really a tale of two retailers you have up at the top. We were just talking about TJX with Adrienne Yih. You take a look at the shares right now. They're down 2.6%. That's after a pretty solid third quarter, but it was the outlook that disappointed. The guidance there for EPS sinking shares today. Then you talk about Target.
Yeah, get to Target.
Totally different story. Stock absolutely flying today, up almost 18%. That's after its third quarter earnings report showed improved operational competence, fewer markdowns, better inventory management. You add it all together. What a day Target's having.
And we should point out, too, I mean, the big sell-off that this stock has had, this is a big part of the reason why you're seeing an 18% bump today, because it had just gotten beaten, just pounded ever since March. Yeah,
maybe a relief rally. And let's quickly talk about NVIDIA. I think I said yesterday that I didn't know why it was rallying, but it was closing in on 10 straight days of gains that tied its record streak. Today, the streak has broken. NVIDIA down 1.7%, still up 233% year-to-date, Romaine.
Okay. Do you have a reason why it's down today?
No. Interesting, though.
I'm going to give Katie some time to think about that as we move closer to the closing bell. Stick with us. Our cross-platform coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick, alongside Katie Greifeld, and we're joined right now by our colleagues, Carol Massar and Tim Stenavik. We welcome our audiences across all of our Bloomberg platforms, television, radio originals, in our partnership with those folks. Carol Massar,
those folks
that are still streaming
whoever they are
on YouTube. Do you look different on the YouTube screen than you do on the BTV screen?
That's a good question.
Yeah.
I don't know. Do I? I don't really look at myself.
No. Oh, stop. Stop.
We actually a little.
Who are you fooling?
Mike McKee's in here. John Tucker's in here. They're both just laughing at us.
I don't. I'm busy working all the time.
Well, I'm constantly looking.
She's full of jokes
Do
today.
you Google yourself?
You know we don't.
Yeah.
One thing that you need to know about the radio studio, even though we have cameras, we don't actually have monitors, so we can't see
Yeah.
what
It's
we
not
actually
until
look like.
you guys come up.
Interesting.
I'm also not shopping. That's what I tell my husband. Having
Good segue.
said
That's a
that,
great segue.
thank you. But your shoppers may be cooling down a little bit. We did see retail sales drop off a little bit. Not as much as everybody expected, but we did see some big revisions upward in the previous months. But it does seem like we are seeing a little bit of slowing in a bunch of categories. Furniture, car dealers, restaurants, and bars. That are down. Maybe Romaine's not going as much to bars lately.
Maybe.
Personal care and grocery, though, they're up. Anyway, so I don't know, but a little bit of a breather, maybe.
I never got bars.
Really?
What do you mean you don't get bars?
I don't know.
That could be
Well,
appeal.
you go in,
There's
you
alcohol.
give the bartender money,
And you just drink.
you get a drink. Yeah.
Get a drink.
You hang out with friends.
That's like a thing,
Yeah.
right?
You know, I will say, even though we're continuing to see
drink alone at home in the dark.
Yeah, come on.
some of this data that does show that, you know, if you're in sort of the soft landing camp, you're kind of adding to the pile of data that you have, in addition to, you know, yesterday's CPI numbers and then the jobs numbers that we've gotten over the past couple of weeks.
Yeah.
There are still those people like Jamie Dimon who say, you know, the market's overreacting and that inflation is stickier than it seems.
Okay, yeah. I mean, I don't know. I mean, I think the trend lines that we saw, quite frankly, at least out of the CPI report yesterday and PPI today, I mean, it shows a decent trend line here. Maybe it's not down fast enough as people want here, but I don't know. Like I said,
Maybe that last mile is just going to be really tough.
yeah, but go back and look at the miles that we've just covered here.
Yeah.
man.
I
We've
will
got-
say on the other side of the conversation, you have Kathy Wood, who Romaine and I spoke to yesterday, saying that actually we're going to see deflation next year. We're going to see negative CPI next year. So between Jamie Dimon and Kathy Wood, who you got? Maybe don't
There's a
answer that.
debate for you, right?
Yeah,
There's a debate.
there's
That would
a
be
debate.
killer.
Yeah, I would pay money for that.
Me too.
Let's
Oh,
talk
that's
about space.
Which side are you taking?
Yeah, that's a good question.
Just viewing, listening.
viewing.
Yeah.
Let's talk about space. This actually, Romaine hand-selected this story, and Tim, I thought of you. It's really interesting. The Biden administration, it's going to ask lawmakers today to adopt a new framework for regulations governing private space flights. You know, we've talked about the billionaire space race. You think about Jeff Bezos' Blue Origin?
Yeah,
I don't
that's
know.
right.
Origins.
And It's been a while. Richard Branson's Virgin Galactic, et cetera. You also have Elon Musk in the ring as well. Apparently, the Biden administration wants to put a few guardrails around that.
I think it makes sense. I mean, look, it's evolving. And one thing that I'll say, Katie, about those three billionaires who you mentioned, one of them has not gone up into space in his own vehicle, and that would be Elon Musk.
No.
So Bezos has gone up. Branson went up.
Yeah.
Musk still hasn't done it.
Oh, okay.
Congestion pricing is just around the corner.
He's too busy posting on X.
It's kind of interesting. I mean, listen,
Has he posted anything interesting lately?
We talk about satellites, right? And there's a lot of satellites up there, so maybe it has something to do with all that stuff.
I am curious though too. I mean, one of the reasons why I was interested in that story too is just really the idea of spinning off Starlink and whether that does sort of become, because everyone, I mean, when you talk about the next big thing that could come to public markets, I think everybody wants to get their hooks into SpaceX or some division of it.
But it's not like he's ever, said he's going to do something before and then doesn't do it.
Yeah, he's got a way.
He's got, exactly. All right, anyway. All right, guys, that's a wrap. We're going to be back in less than an hour's time. We're going to count you down to the close, some earnings too after the close as well, Cisco among them. So join us on radio, TV, YouTube, and of course, Bloomberg Originals. We'll see you at 4 p.m. Wall Street time.
As we say goodbye to Carol and Tim, we continue to count you down to the close here on Bloomberg Television. Just about 50 minutes to go until we get to those closing bells, and a closer look right now at what's going on across the landscape in real estate. Real estate stocks right now having a pretty good week on the back of hopes the Fed might actually be done with that hiking cycle. Office REITs up more than 10% just over the last 3 days alone. Our next guest focuses on investment in that space. Liza Crawford is co-head of global securitized assets over at TCW, and she joins us right now in studio too. Great to have you here.
Great to be here. Thanks for having me.
I would assume that the fortunes of the real estate market, the REIT market, if you will, are tied to your bet or your outlook for rates and where they go, and more importantly, where they stay here. I guess this is a two-part question. A, do you think the Fed is done? And B, do you think rates are going to stay elevated where they are?
Our house view is that the Fed is done or near close to being done, and we're positioned accordingly. And I focus on the investments in debt, so less so REIT equities. But on the investment side, you can see that with our debt. And then with respect to, sorry, the second question was?
Whether rates stay where they are. So are we in this higher for longer rate environment?
I think we're prepared for higher for longer, though there are repercussions from that, and we expect to see them, and we're already seeing some of that in the commercial real estate market.
We've been talking a lot, though, about those repercussions, some that really haven't come to fruition yet. Obviously, there are a lot of folks that maybe still have to refinance at some point over the next couple of years, and what kind of environment they're going to face when that finally does arrive. How does that change how you sort of pick and choose your investments, and even for that matter, how you look at what's currently in your portfolio?
We are very careful on our security selection. We're bottom-up credit analysts at TCW. We focus on more resilient credits. These are lower leveraged assets with strong sponsorship that can invest in their portfolio to really generate additional demand. Office is a great example. So in today's market, you need to pay up to bring high-quality tenants into your property. And then there are some areas that have secular tailwinds still, like data center. So we're very focused on specific credit curation. And then you mentioned the upcoming maturities. There's around $1.5+ trillion of commercial real estate debt maturities in the coming years, and they will face a real rate shock. What we anticipate is that lenders will work with borrowers to try to mitigate that impact through extensions. The difference is for some assets that have a more troubled future, or in office, you're seeing Class B, C, properties that simply just don't have any more demand, or their demand has diminished tremendously, their value has diminished, so sponsors are strategically exiting those assets. We're mindful of all of that in our investments.
Well, Liza, when you're thinking about offices and some of the challenges facing that space, one of the conversations that has worked itself into the zeitgeist is the idea that maybe you could repurpose some of those offices to maybe be more attractive, more usable. Are you finding any opportunity along that theme? It's
such a great thought, and it would be really wonderful to address the lack of housing with office conversions. However, it is much easier said than done. Kind of 2 points to highlight on that. One, the entry basis for that conversion is going to be very low. So that doesn't insulate a debt investor from losses if they were to invest in a property that was designed as office, that was valued as fully occupied office, and then goes through redevelopment. And then additionally, for redevelopment, when we talk to experts in that field, the focus is more smaller properties, so call it 250K square feet with attractive floor plates and a lot of lighting, natural light. So there are certain aspects of properties that lend themselves better available for redevelopment. I'll also add that it takes a lot of effort around construction and penciling out the economics. So we'd expect a lot of tax rebates, whether it's historical tax credits or affordable housing, tax exemptions, to make the economics work.
So it's a great idea. Maybe it doesn't quite work in practice. We only have about a minute left with you, but let's talk about traditional housing. How does the residential real estate market compare to the commercial real estate market right now?
Completely different. The residential housing market is very resilient. We have undersupply of residential housing for the last 10 years, and then we've benefited from the experience of the global financial crisis. Underwriting for new mortgages is very high quality, and a lot of mortgage borrowers have benefited from low rates. So we have so many borrowers in 30-year fixed-rate mortgages at very low coupons, 4% or below. That makes them insulated from the current rate environment, and then the supply, the limited supply insulates the broader housing values from any severe scenario where there are rising unemployment and defaults for housing, for mortgages, for real estate mortgages.
All right, Liza, sadly have to leave it there. Have to have you back soon. Really enjoyed this conversation. That is Liza Crawford. She is co-head of Global Securitized over at TCW. Now, coming up, we'll dive into all the latest economic data as retail sales slowed in October and producer prices unexpectedly declined. What it all means for the Federal Reserve.
Plus, the battle between Texas Attorney General Ken Paxton and Wall Street's biggest banks, what it can mean for the muni market.
And short sellers like Carson Block are teaming up with the SEC to go after misbehaving firms. We'll explain what's driving this unexpected alliance. All that and more coming up.
Like
this is The Close on Bloomberg.
Are there pandas involved in that?
I hope so.
All right. It's time now for our Muni Moment and a closer look at the battle between Texas and Wall Street. Texas Attorney General Ken Paxton aiming to put a check on which big banks win business from the state and its municipalities. Decisions that are going to be made based on his perception of whether those big banks are playing politics with their money. Bloomberg's Danielle Moran joining us for a little bit more. And Danielle, let's actually go back to the end of last month, the end of October here, when Texas had that big, Municipal Advisory Council meeting, which I doubt anyone outside of Texas ever paid attention to until this year.
Except Danielle.
Except Danielle, right. But this was a big deal because he really did articulate Texas's position on these issues. And this seems to be based on his own perception and the perception of some of his allies that some of these banks are making decisions with their money on some of these hot button political issues like gun control and climate change.
That's right. Ken Paxton has been sort of at the center of this debate of whether or not Wall Street has these policies that might restrict them from doing business in Texas. So he has launched a new investigation into about 10 financial companies who are members of the Net Zero Banking Alliance. And what he's trying to determine is whether or not being a member of that group seeking to cut greenhouse gas emissions is essentially boycotting fossil fuels, because Texas has this law that says if you are a fossil fuel boycotter, energy boycotter, you're unable to get public contracts, and that relates to the muni bond underwriting business.
Well, that's where I wanted to go, because you peel back the layers of pretty much anything and it becomes a muni bond story. But how exactly is this a muni bond story?
I'm glad you said that, Katie, because we think the exact same thing in our group. And this is really directly related to munis, because if you can't participate in this market, then you wouldn't be able to underwrite these bonds. And the bonds fund everything in Texas. From its booming infrastructure, you have schools, you have roads, infrastructure, airports, all of it is related to the financing. And so Ken Paxton oversees the muni bond market in Texas. He is the authority to say whether or not a bond deal can close. And so he is really at the center of this.
He's certainly center. And I mean, we're going to try to put aside politics because we know a lot of what's come out of his mouth has just been really just nonsense, to put it plain and simple. But it gets to the broader issue here that he is also supposed to be a steward for the finances of the state here. That you had a chance to sit down and interview him. The decisions he's making, does he in any way feel that it could impact the amount of money that Texas has to pay for additional issues going forward?
He said that this is his job. He was given the direction by the legislature to enforce the laws that they put in place. So it's his jurisdiction to be able to decide how these banks' policies might be in a...
I'm sorry, I just want to reframe the question because I'm not asking about the policies. I'm asking about interest costs and whether the decisions that he's making on policy are going to lead to them having to pay higher interest rates. Did he address that?
Right. I mean, he sort of addressed it. He said that there are a lot of banks that want to do business in Texas, and some of them can step in and fill the void that some of these other banks might have left, and there probably won't be a cost to that. I think whether or not that is true remains to be seen, and it really depends on the scale and in which he's willing to go. If you ban one bank, it has a smaller impact than if you ban 10.
All right, Danielle Moran helps lead our municipal bond coverage here at Bloomberg. A closer look at some of the decisions being made down there in Texas. We do want to broaden out this conversation on munis and talk a little bit more about some of the trends that we're seeing across the space. Our next guest says 2023 has been another lackluster year following that horrendous 2022, but bond issuance in the muni market has started to pick up over the past couple of weeks with that rally in rates, and the big question is, how much further can it go? Jonathan Mondillo joining us right now, head of North American Fixed Income over at ABRDN. And John, let's start there here. I mean, we've seen a little bit of a perk up in the market here, and I know there's been a lot of the sort of waiting for some sort of stability in the Fed rate environment, the Treasury rate environment, that maybe gives a green light to the muni environment.
Yeah, I mean, a lot of investors in the tax-exempt municipal bond space are probably still licking their wounds. As you said, 2022 was nothing short of a bloodbath for municipal investors who are not used to seeing red. This year, lackluster up until about 2 weeks ago. But I think for us, we've been looking for sort of that catalyst that gets investors off the sideline, right? Where has the money gone to over the last year to 2 years? It's been to T-bills, it's been to money market funds. And I think as we get to peak cycle, which we feel like we're at right now, investors need to start thinking about where they're going to be invested long term. We think tax-exempt munis are extremely attractive at the moment.
Well, that's exactly what I wanted to talk about. How do you compete with cash right now? Is it just warning about reinvestment risk and talking about the long term?
It's tough. It's been a difficult conversation, but I think if you look at taxable equivalent yields, whether it be at the front end relative to municipal money market funds versus Treasury money market funds, or if we extend out longer, there's still a pickup on a taxable equivalent basis within tax-exempt municipal bonds. I think secondarily to that too, missing out on what could be pretty hefty total returns on a go-forward basis is what investors need to be focused on. So there's that excess yield component, which I think is attractive in tax-exempt munis, but also from a total return perspective, in a pause environment, munis out-return T-bills. Munis have out-returned, at least over the past 3 pause cycles, the S&P 500, as well as corporate bonds. So investors, I think, really need to wake up here and start to invest in the asset class.
Well, what's the downside here? What is the biggest risk to the muni market as it stands right now, would you say?
I think the biggest risk to the muni market is, as it always is, which I view as very minimal, which is the loss of tax exemption. But headed into 2024, it's always talked about when we go into an election cycle. I just think that when we weigh that outsized risk versus the potential returns, municipals as an asset class, it's tough to find a better or more attractive asset class, right? So if we're entering a recessionary environment, fundamentals look extremely strong relative to other asset classes. Yield component, we're now at certainly 10+ year highs in terms of yields. And then I think what gets lost too is when you compare ratios of munis versus corporates, when you compare ratios of munis versus treasuries, they look pretty much in line, right? But I think what gets lost as well is the fact that when yields tick up, the tax exemption that gets passed off to investors goes up as well. So at a 1% yield, it's worth 58 basis points. At a 5% yield, it's worth 300 basis points of excess income, and that's real.
And that's a good place to end it. John, it's really great to see you. That is John Mondillo. He is head of North American Fixed Income over at ABRDN. Meanwhile, much more ahead. This is The Close on Bloomberg.
Welcome back to The Close here. Keep an eye on the markets as we count you down to those closing bells. Just a little more than 30 minutes away here at Katie Greifeld. Stocks have been kind of oscillating all day, but still holding on to some modest gains coming off, of course, what was a monster day yesterday.
A monster day yesterday. You think about some of the eco data that we got today. Of course, we did see a decline in retail sales, a little bit less than had been expected, though. You take a look at PPI. That actually posted a decline as well, had been anticipating a slight rise. So you marry it all together, it seems like that soft landing nirvana that Neil Dutta from Renaissance Macro was talking about yesterday, not seeing it necessarily, that enthusiasm in stocks.
Do we owe Jay Powell an apology?
Someone does.
Yeah.
Not you and I.
Well, yeah, not me. I never apologize. But look at that. The KBW Bank Index having a pretty good day as well, up about 2%. Stick with us. This is The Close on Bloomberg. This is the countdown to the close. Just about 30 minutes left to go here in the trading day, Katie. We don't have the fireworks like yesterday, but we still have some green on the screen.
Yeah, not exactly the 2% rally that we were looking at about this time yesterday, but the S&P 500 still up 0.2, 0.3%. You take a look at the sector level, it's more of a mixed bag. You do have more green than red, so let's get into it. Up at the top, you have consumer staples up by about 0.8%. Financials not too far behind, up about 0.7% as well. So too is the materials sector. You go down the list though and take a look at what's relatively lagging today. There's not much. You have big tech there down by 0.1%, utilities as well. Energy off by about 0.2%. So some losers today, Romaine, but pretty small moves.
Yeah, pretty small moves. In fact, some of the biggest moves we had today are actually those companies that reported earnings. We talked about Target a little bit earlier, one of the biggest percent gainers out there, at least in the large cap space here. We got quite a few other earnings on tap here over the next few hours here. That includes Palo Alto Networks and Cisco, which are actually set to report earnings after the bell tonight. An interesting setup here for the tech space as a lot of people really look at some of the softness that we've seen when it comes to business spending and enterprise spending and whether that'll carry over into the numbers that we get later tonight. Of course, we're also going to get a lot more out of the retailers here. You see Macy's having a fantastic day, up about 8%, and that's largely because of some of the optimism you have right now around not only the results that you got out of Target, but of course also some of those retail sales numbers out of the government that suggests that, yes, it suggests that, well, consumer spending, while the headline number is contracting, there are a lot of pockets of strength there, a lot of pockets of consumer resiliency. Does that also affect Walmart? Well, investors seem to think so, bidding that in stock up about 1% here on the day, Katie.
Well, Romaine, on that note, you saw U.S. shoppers take a breather in October. That's after a summer, though, of big sales. Retail sales slipped in 7 out of 13 categories, but shoppers still remained more resilient than expected going into the holiday season. Joining us now to break it down, we have Greg Portell. He is lead partner for global markets over at Kearney. And Greg, you think about some of the worst case scenarios that were trotted out for the consumer over the past few months, over the past year or so. It seems like we're still far away from that point.
Yeah, investors have been looking for that consumer fall off for a while now, and consumers, particularly U.S. consumers, have been remarkably resilient through the pandemic and then all the way in as the inflation has hit them. So overall, it's still a very positive consumer profile heading into the holiday season.
And let's talk about that, of course, heading into the holiday season. When you compare what we're expecting this year to maybe what we saw last year and maybe some of those pandemic years, what's your base case for what to expect?
I mean, all the numbers really suggest like a 3 to 4% growth rate, which is still very strong considering all of the headwinds that the consumers are facing. Now, unfortunately, it's not the tidal wave of success we've had the past couple of years. So there will be winners and losers as we go into the holiday season.
So when we get to this idea, though, I guess, of the overall trends here, I mean, the holidays, Greg, I think a lot of people look at holiday spending as almost a necessity, right? Like, you're not just buying for yourself, you're buying for other people. You know, even if you're buying stuff for your house, like decorations and stuff, it's this idea here that this is just what you do. Even when times are bad, you're still going to spend this money. Do you anticipate, though, that there will be a shift in that spending, maybe into certain pockets, or maybe sort of a drop, I guess, in some of the aggregate levels?
Well, I think there's two things we've learned. One is that there is a limit to how much retailers can creep up holiday spending, which is why you don't see a really bouncing October. But when you look at November and December, we're going to expect to see spending on more near-term consumption items. So think about clothes, think about entertainment, think about food and beverage, because those are areas where the consumer is less sensitive to the interest rate. You start thinking about cars and some of the longer-term purchase items, those are going to get very pricey when you start factoring in the cost of the interest.
I'm curious, too, about some of the promotions that we've seen already. I mean, we're still a week away from Thanksgiving, and I remember seeing in my email box, even as far back as like mid to late October, I was already getting quote-unquote Black Friday promotions. Here, are we going to see a lot more discounting this season relative to what we saw in the previous couple years where the discount seemed, at least to me, pretty meager?
Well, one of the things we've noticed is that the retail supply chains seem to be stabilizing. So you're not going to have that whipsaw effect of panic from the merchandising side to try to move product. What you will see is very smart retailers start to look at the data they have and do targeted promotions. They're going to be very smart, putting the right information in front of the consumer at what they think is the right time. So rather than the mass 50% off signs we've seen in stores in past years, we would expect that promotion to be much more targeted and much more surgical in terms of the consumers it's after.
And Greg, we're talking about, U.S. consumers, the retail sector, sort of in blanket statements right now. But you point out in your notes that the consumer strength isn't strong enough to benefit everyone, that brand power still means something. And with that in mind, I mean, what kind of companies are positioned to do well here relative to some of their peers?
You really are seeing that bifurcation of consumers, because at the high end, consumers are looking for brands. They're looking for brands that can innovate and create reasons to buy. And at the other end, they're looking at brands that can, or products more specifically, that are able to meet their cost expectations. So if you're a company and you have a portfolio of products that are sitting in the middle without a real price differentiation or without an innovation pipeline that allows consumers to really get excited, you're going to have some problems. So look to avoid those companies that are in that middling ground, because there's just not enough differentiation, particularly in the consumer's mind, to lift them up.
Is there still brand loyalty, Greg, particularly on some of those more discretionary items?
I don't know if I would call it brand loyalty as much as it is brand strength. So consumers will move from place to place, but within their consideration set, they're going to remain strong. Now, what we have seen is consumers changing what their priorities are. So it's not necessarily this mythical trading down as much as it is trading off. So they're going to look for different attributes at perhaps a lower price point, but they're still going to try to stay in that same brand family.
All right, Greg, really enjoyed this conversation. That is Greg Portell of Kearney. Now coming up, the deal is off between Stephen Schoenfeld and Izzy Englander's Millennium. We're going to bring you those details next. This is The Close on Bloomberg. This is the countdown to the close. I'm Katie Greifeld with Romaine Bostick, and joining us now is Scarlet Fu. And Scarlet Fu, we're going to talk about New Jersey.
Yeah, because as part of our top 3 people we're watching, they don't call Goldman Sachs government Sachs for nothing, because Tammy Snyder Murphy is another Goldman Sachs alum who will be running for public office. She's the wife of current New Jersey Governor Phil Murphy, who himself is a former Goldman Sachs banker as well. Just for anyone keeping track, while at Goldman, Tammy Murphy focused on real estate and investment banking in the late 80s. So she is, of course, going to be running for the U.S. Senate seat that's currently held by Bob Menendez, who is indicted on bribery charges. By the way, fun fact, she's running as a Democrat, but for years she was voting as a registered Republican.
No, intrigue there.
Yeah.
Bob Menendez.
Yeah, Bob's aren't looking too good for him.
Yeah, I didn't know he was still in office, but okay.
Yeah, still in office for now.
They do things differently in Jersey.
It's a fun place, and we're talking about New Jersey's first lady, as it were, so it's going to be really fascinating to see how that plays out. But let's switch gears here, because it's 13F season, and some interesting details came out about Stan Druckenmiller, Duquesne, the family office that he runs, basically taking profits when it comes to that big AI boom that we've seen. You take a look at their NVIDIA stake, they actually cut it. That is the first time this year that they disclosed a drop in their holdings of NVIDIA. You saw the same thing from George Soros's family office as well, offloading the stock in the period. NVIDIA, of course, is up something like 230, 240% this year. Makes sense that you'd want to take some profit.
We touched on this yesterday when we were talking to Hema Palmer, when some of the 13F filings are coming through, and you had names like NVIDIA, which are like what has tripled this year or something like that. It's like, of course you're going to have profit taking, but did that money go anywhere else into the AI space, or is this basically just him just cashing out his chips and saying, hey, might as well just take a victory lap and count my money?
It's a great question. I mean, recycling it among that theme, I'm not sure. I mean, these 13Fs are always hard to read. So.
If retail money is dumb money and institutional money is smart money, then what are family offices that manage ultra high net worth individual money? Rich, savvy money, elite money.
That's a good question. We'll have to think of some adjectives, I think.
All right. Another story, another person that we've been keeping an eye on. This has to do with Millennium, Stephen Schoenfeld and Izzy Englander. And I thought this was a great story that Hema Palmer wrote that talked about basically kind of the lifeline, effectively, that I guess Schoenfeld got. I mean, he was basically going to do this tie-up with Millennium, and then I guess at some point he was able to raise some money from other folks, and it was told Izzy, I'm sorry, buddy, I don't need you anymore.
Yeah, it
they
was
got
a
very close to something.
A great TikTok. I love these pieces of reporting. A 5 p.m. call in New York on a Tuesday.
Yeah, which, I mean, it sounds more dramatic than it is, but when I saw it, I was like, oh, okay, isn't that like, is that like past the witching hour or something?
But is it a super hedge fund bailing out another super hedge fund? I'm not quite sure of the backstory here.
Well, let's get that backstory. Emma Palmer is the reporter on that story. She joins us right now here on set and kind of explain this to me because, I mean, this looked like, I mean, at least the speculation in the media that this was a done deal, but apparently I guess he was able to find another lifeline, a lifeline of billions of dollars.
Yes, this had been conversations, talks between these two big firms going on for months and months, trying to figure out if there was a deal, what it would look like. And then it looks like at the 11th hour, Schoenfeld was able to raise about $3 billion from other investors, giving them that capital to then say no to the Millennium deal, which speculation was like, there were a lot of questions over how that deal would look, what that would mean for existing Schoenfeld investors, what Izzy and Millennium would be asking for, and really a lot of the logistics around that. There were a great deal of uncertainty there.
What was Schoenfeld going to do for Millennium if they did reach some kind of partnership agreement?
So it's a bit unclear, but talks were that Millennium would invest billions of dollars into Schoenfeld. And then there was a lot of speculation over what would happen to some of the PMs, or would this be something of a potential takeover? Or, you know, there were a lot of, people were very, very curious as to what the technicalities of this partnership would be, given that Millennium essentially has the upper hand in this deal, and Schoenfeld has been struggling for some time. So if they were able to secure money from other investors elsewhere, those were probably at
what's the deal with this 5 p.m. call? Why did you put this in your story? Because it's really bugging me now that you brought it up, because I'm thinking, like, I mean, that's not really late, right? I mean,
it's not late, but it's an interesting little detail about how these things sort of unfold. With the talks between these two very big firms, ultimately the call is between the two billionaires.
All day, you know.
Yeah.
So it's
I mean, this has been going on for weeks or months.
Months. It started in the summer sometime, and it had been talks were unraveling and going back and forth, and so yeah, it's definitely been closely watched by the industry.
All right, so Schoenfeld's going to stand on his own right now. That's the plan, and Millennium goes on and I guess buys like another 25 hedge funds.
Well, it does speak to this issue of consolidation and struggling to find talent for a lot of these very big firms that have grown a great deal in their assets.
All right, Emma Palmer's all over this here, covering hedge funds for us here at Bloomberg. Stick with us. We're counting it down to those closing bells. Nicole Webb, she's on deck. This is Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Scarlet, who will focus on the equity markets right now. An equity market, of course, had its best day going back to April of this year. A little bit more muted gains today, to be sure, but nevertheless, an extension of that rally.
Yeah, holding on to the gains, and the latest data show the Goldilocks economy remains on track. You had wholesale inflation unexpectedly decline, reinforcing the cooling CPI report, and of course, retail sales also slowed down as expected. What's different today, of course, is bond yields are higher, so that's kind of muting the gains we're seeing in equities. Traders are reportedly resetting bets on higher yields through the futures market, so that's new shorts against treasuries, so that volatility in rates continues to be the driver of what's going on in equities. What I found interesting was the Russell 2000 yesterday, and I know you covered this, up 5% yesterday and holding on to its gains as well.
Yeah, and more importantly, I think the differential between the broader market here, you haven't really seen that type of outperformance. I think at the time, what was it, like since like 2020, basically early 2020. And I think that's what most people want to see, a little bit more of a broadening out of the rally. Whether the data supports that or not, I guess that's going to be the big question going forward. Let's get some insights out of our next guest, Nicole Webb. She's Vice President and Financial Advisor at the Wealth Enhancement Group, joining us to help count down to these closing bells. And let's start off actually here with the consumer. I mean, we were talking about the CPI report from yesterday. We got PPI this morning, which also seemed to sort of ratify that downward trend, that disinflation trend. But we also got a retail sales report, and that was overlaid with some earnings out of several retailers here. I'm not sure what the takeaway is, because some of it was really good and some of it, I guess, was maybe not so good. But overall, do you think the consumer is going to hold up?
Yes.
Yeah.
And I think the labor market is the catalyst for it. And
It's really this simple. We're having disinflation faster than economic erosion. And so that is textbook soft landing. The consumer hasn't fallen off a cliff. Labor hasn't fallen off a cliff. Growth hasn't fallen off a cliff. And we've had great earnings. Q3 has looked fantastic. And so this story or this plot line, the Baer narrative around, well, what if everything softens? What if everything falls off a cliff in 2024? There's just nothing to support that trajectory over the coming quarters.
But how do you manage your clients' expectations? Because the reason why you say that is because, let's face it, everybody was saying that coming into this year, right? That this was going to be the year of the recession. This was going to be the worst year for markets that we've seen in, who knows how long. And of course, we got almost the opposite story. And now there's this fear that, well, I might have already missed out on the rally, so why would I recommit into this market right now if that 17% gain on the S&P is the gain on the S&P?
And there is no doubt that it has been a tale of two markets. And for the consumer, the thing that I weigh so heavily on inside of our firm is that we have to remain vigilant in our expectation of continued volatility in interest rates. It's not just about the Fed. It's also about government debt. It's also about bond auctions. It's also about data that's coming in the next couple of quarters. We also need to couple that with the fact that we are prescriptive in our investment strategies around the many possible outcomes over a short period of time, knowing the high likelihood over a longer. So again, as an investor today, you actually have the opportunity to play the duration trade, the growth trade, the tech trade, and be really mindful about the fact that this market today has presented endless opportunities for an investor, as opposed to being stuck in this siloed narrative of doom and gloom. The world is ugly. And it is filled with opportunity if you strip out the noise, this multiple expansion on these top names, look below it and say, okay, these balance sheets look good. There's been a true up of how these businesses are being run. And at some point, that performance and the share price have to marry each other. It hasn't happened yet.
It hasn't happened yet. It's been something that people talk about, but everyone gloms on to 7 companies in the S&P 500. You mentioned interest rate volatility and how it comes not just from the Fed, but from bond auctions, and of course the deficit as well. What about the now active trading by hedge funds, which move interest rates day to day? We talk about this recommitment by traders betting on higher yields. Are your clients looking to actively trade treasuries in a way that perhaps once upon a time they traded equities?
Yeah, I think that's incredibly insightful. And there is an element of, when we think about diversification, and this is where our firm takes such a hard stance in educating our clients, there's multiple forms of diversification. And one that is omnipresent today is the need for both active, passive, and tactical management in alignment with the fact that markets move differently. The velocity of change is speedier today than ever before. And so we have to think differently about what is mandated to being held to its duration, and what, if we do play to the interest rate movements and think more tactically about how we think about laddered T-bills and treasuries. So I would say that's something that we definitely are talking about.
You talked about a textbook soft landing. Where does that leave small caps, which are so closely tied to the economic cycle?
That is one of the most present kind of investment thesis right now, is just the fact that the small caps have been annihilated on the pretense of higher for longer, as in higher forever. And look, there's been no reward for moving money into the market in 2023. 2024 is setting itself up very different. If you hadn't started to think about small caps, you missed out on yesterday's performance. It's held true today. And when we look at the year ahead, there is likelihood, because this looks different than the 1970s, it might look more like 1995, where the Fed says, well, let's test the waters and really slowly bring down rates, see if there is that reacceleration of inflation. And if there's not, then we can actually cut rates in an environment where the market is near all-time highs. It has been done before. We cannot lose sight of it.
And final question here, and I am curious just about the competition for return, the competition for yield, competition that didn't really exist, during the last bull market cycle.
Yeah, the restoration of greed I mean, that is really the thesis here for what is the next leg of this market. The restoration of greed, the understanding that 5 isn't good enough when we see 5% moves in one day and they stick.
Yeah.
And so when we think about where the rotation comes from, I don't think that mega tech has to be annihilated. Our firm looks at it and says it may just have relative underperformance as we watch the rotation actually come from money markets and T-bills entering the public markets on the equity side.
All right, Nicole, going to have to leave it there. Great to catch up with you.
Thank you.
Nicole Webb of the Wealth Enhancement Group helping us count down to these closing bells. Just about 2.5 minutes to go here, Scarlet. Stocks holding on to their gains here on the day. And of course, the moves that we saw in the Treasury market yesterday with that massive drop in yields, somewhat of a reversal today. Yields higher across the board, but only by about 8 to 9 basis points.
Only about 8 to 9 basis points. Could you imagine saying that a year ago?
I know, after a 20 basis point drop yesterday here. Stick with us. We got a lot to parse here as we get closer to the closing bells. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine, Bostick alongside Scarlet Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms. Here on a day where the market trying to extend that monster rally that we had yesterday. A rally, not necessarily monster, but I think some people will take it.
Yeah, listen, we definitely saw some momentum. We were just talking with Abhay Deshpande over at Centerstone, and he said it's really fascinating when you have, 473 of the companies in the S&P 500 finally participating in the rally. So
493.
Really, 493,
yeah.
Right. The other 7 that are typically, yeah.
Oh.
See, we talked about
So
that.
you get to correct Carol, too, all the time. I thought it was just me.
His point was, it was so great to see it be so broad-based, and it talked about how significant that was as a move. So, yeah, you sit up and take notice. Maybe we're taking a little bit of a breather today, but nonetheless, it's pretty significant.
Put everything in context. This has been, I think it's fair to say it has been a monster rally. And the thing that still surprises me, Scarlet, is just how much sentiment has shifted in just 2 weeks. I mean, it is pretty incredible to see what the stock market has done and the different ways that people are talking about this and what bond yields have done over that time, too.
I know everyone said 4.5% was kind of the line in the sand for the 10-year yield. Well, we came below it. We're now back above it, but it's not like sentiment has turned around because we're now above 4.5%.
Yeah, absolutely. And it gets to this idea, too, of whether some of this is premature. I thought some of the commentary that we heard out of Dan Ivison over at PIMCO, who spoke to Bloomberg a little bit earlier today, really kind of saying, look, people are getting ahead of themselves, that they really are starting to aggressively price in rate cuts here. The fight against inflation, in his words, is far from over. Nevertheless, we do get a modest extension of yesterday's monster rally with all of the major indices here in the U.S. finishing the day in the green. That includes the Dow Jones Industrial Average, which is up about 160 points, or about 0.5%. The S&P 500, a close back above 4,500, up 7 points, or about 0.2%. While the Nasdaq Composite is going to finish higher by about 10 points, or roughly about 0.1%. And take a look at the Russell 2000, a relative outperformer, at least relative to the Nasdaq and the S&P, up about 0.2%, or about 3 points here on the day.
All right, so we said it was really broad-based yesterday. Not as much. If you look at the S&P 500, over 300 names, Scarlet, in that index, higher in today's session, about 198 to the downside.
Yeah, but it's still more than 5 stocks higher for every 4 that is down in the New York Stock Exchange. Yesterday, that advanced decline ratio was 15 to 1, or almost 15 to 1. When you look at the sector performances, food and staples, that's led by Target leading the way, up by 2.5%. Autos and components, up 2%. Banks, all 15 members are higher today. On the downside, you've got retailers down 0.9%, along with insurers and utilities marginally lower by 1/3%.
You were cold. You had a cold, didn't you?
I did. Yeah. Sorry for the squeaking.
No. Hope you're feeling better. All right, so let's get to some of the individual gainers in today's session. Target, number one gainer in the S&P 500. We've all been talking about really the outperformance in this name today, finishing the day up almost 18% in today's session. Third quarter earnings beat. They talked about the business basically operating better. So that means inventory management, fewer markdowns. And this is despite comp sales falling for a second straight quarterly drop, driven by lower spending on discretionary categories. So real outperformance there. Disney, definitely on our radar. radar. They've now got 2 activist investors who are pushing for some changes at that company, and it was up more than about 3% in today's session. This time, you got Value Act building a significant stake in the company. They've been in talks apparently with Disney's management. Still and is still increasing their stake in the company. Nelson Peltz, as we know, and his Trion management, they've been looking for some board seats over at Disney. So there's definitely, we know, we continue to watch this one, keep it on our radar. SiriusXM.
I am curious about this too, because I thought Iger had kind of slayed this dragon when he came back, and the idea got some of these activists off his back. But the fact that they're coming out of the woodwork now seems to suggest that maybe he has a little bit more work to do. I agree, right? And it just like they're all looking for some more things to do. There's so many different moving pieces. You think about what value. Obviously, everybody talks about ESPN, but what else could be unlocked in terms of creating some value there? SiriusXM, top of the NASDAQ 100 as well. Berkshire Hathaway disclosed a new position in the company after holding stocks that track the company. They basically had shares of different Liberty Media entities that track SiriusXM, but now they've got a 9.68 million share stake in Sirius common stock. It's worth, just under $44 million as of September 30th. So we saw Sirius definitely up about 6%. And I just want to mention those Chinese names that trade in the U.S., that was some outperformance. The NASDAQ Golden Dragon China Index, it too rallied about 2.5% or so. E-commerce company JD.com with sales that beat, lowered expectation. Tencent ADRs were soaring today. That company, the internet company, reported better than expected profitability across its main business line. So definitely some outperformance there.
All right, well, let's look for the underperformance, and we got to start with NVIDIA. It turns out that NVIDIA stock does indeed go down today, the first day down after a 10-day winning streak, falling 1.55%. The company's first down day, as I mentioned, after 10 days of gains. During that time, it climbed more than 20% during the 10-day rally, adding close to $220 billion in market value. That's according to data compiled by Bloomberg. TJX Companies, it's the parent company of TJ Maxx and Marshalls. Shares falling 3.3%. Home Goods as well, among other companies, I could say. How's that? And then the Canadian companies too. Right?
Oh, yeah, I forgot about them.
We can't forget about those.
They're big in Canada.
They are huge in Canada. The company lowered its fourth quarter projection for profit. The fourth quarter outlook for comp sales also fell short of the average analyst estimates. Some analysts said that it's kind of a conservative outlook, especially given that the company is certainly off to a strong start, at least according to executives on the call today. And then the worst performer on a percentage basis in the NASDAQ 100 and the S&P 500 today was Vertex Pharmaceuticals. Shares extending a decline that started a couple of days ago, actually yesterday, after the company gave an update on the design of its mid-stage trial for its investigative therapy for acute pain. One analyst said that because the trial does not include a placebo, it's, quote, negative for investor perception. Shares down by 5.6% today.
I didn't know you can do a trial without a placebo. But,
I didn't know you could do that either. I thought the whole point of a clinical trial was a placebo. You know, double-blind trial too, as well. So I guess that's why investors are selling the stock.
All right, let's check in right now on what's going on in the yield space. Actually, before we get to that, guys, we are getting some earnings crossing the wire. We were expecting Cisco earnings, and they're now hitting here. Let's go right to them right now. The company for the most recent fiscal quarter here, saying that revenue came in at $14.67 billion. That's for its fiscal first quarter. That's pretty much on the nose of what the street was looking for. Adjusted EPS looks like a more meaningful beat at $1.11. The street was looking for $1.03. Here's your forecast. And I'm going to start with the fiscal second quarter, which is the quarter that we're in. The company says it sees revenue in a range of $12.6 to $12.8 billion. The street was looking for $14.2 billion. Wow. So that is a big miss there on 2Q revenue guidance. For the full year revenue guidance, $53.8 to $55 billion. That's lower than its previous guidance that it gave, which was at $57 to $58.2 billion. And we should point out, with its new range, which is at the top end of that range at $55 billion for the full year, the street on average was looking for $57 billion. We're actually close to 58. I'll just round it up here. So even if they hit the top end of that range, they're still going to come in about $3 billion below the average estimate. All right. Well, Cisco plummeting about 14% in the aftermarket. It's going to have some company because Palo Alto also down about 11% here in the aftermarket. It's just coming out with its earnings as well. And the company talking about the fiscal year adjusted EPS. Let's go to Outlook, 540 to 553 a share. That looks actually better than what the street was expecting of a 533.
2023. If you go to second quarter billings, 2.34 to 2.39. Estimate is for 243 billion. First quarter adjusted EPS, so that's the quarter that just happened, $1.38 a share. First quarter revenue, 1.9 billion. That's a bit of a beat. Estimate was 1.84 billion, but it doesn't look like it's enough for investors. First quarter remaining performance obligations, 10.4 billion. That's a little bit below the estimate of 10.62 billion. That's kind of interesting because it does look like it is upping its outlook, at least for adjusted EPS there.
Yeah, but the thing is, Palo Alto Networks is the sixth best performer in the S&P 500 this year. It's gained 84% this year, and we know that its rival Fortinet had warned of a spending slowdown because of reduced tech spending. So there are already people positioning for some kind of disappointment ahead of these results.
Well, then we kind of dovetail that back to Cisco? Because I was just looking at their release, and they are talking a lot about a slowing orders for networking and hardware. And I know that's different than Palo Alto, but it is kind of cut from the same cloth, at least in terms of the type of enterprise customers that you're dealing with. And if they're slowing those purchases, I wonder if there was a bit of a pull forward. Because remember when we were getting these results out of Palo Alto, and even Cisco, just I felt like 2 quarters ago, they were like knocking it out of the park on certain issues. And it raises the question as to whether some of these companies had just kind of stockpiled things and now they've got what they need.
Well, it's
like refrigerators.
The Cisco's CFO actually addresses this in commentary. Scott Herron, the CFO of Cisco, saying, after customers implemented large amounts of recently shipped product, we expect to see product order growth rates accelerate in the second half of the year. He continued, the company delivering operating leverage and increasing capital returns to our shareholders. So expecting the second half of the year to see those accelerations.
Remember, they just bought Splunk. There's a lot going on at that company. They're trying to go to a model where, you know, it's software, it's recurring revenue. There's a lot going on at that company, but nonetheless, it's not what investors want to hear. So we're seeing both of these companies.
But the thing is, the Splunk deal's not even done. I mean, they still got to close that and do the implementation. So anything that's accretive out of that, I mean, it could be a few quarters before investors actually see it.
No, it's a really good point here in terms of the impact. All right, guys, but 2 names that are definitely lower here in the aftermarket, Cisco and Palo Alto Networks. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. We will see you again tomorrow.
All right, continuing our coverage right here on The Close, we'll dive a little bit deeper into some of those earnings that we just got out of Cisco and Palo Alto Networks. But we also want to have a conversation here about options becoming one of the hottest trades on Wall Street. We're going to talk with the vice president of Moomoo, which is teaming up with SIBO to make options trading easier for retail traders. That conversation coming up on The Close right here on Bloomberg. An extension of yesterday's monster rally. The extension, well, somewhat modest, at least relative to what we saw yesterday. But I think a lot of investors would take it. All of the major indices here in the U.S. posting green on the screen here, as some people are finding some optimism in that economic data, and of course finding some optimism in some of the earnings report. The S&P 500 holding that 4,500 line, but you actually saw some interesting bids come into the cyclical space here. You saw that reflected in the Dow Jones Industrial Average, and in fact, the big outperformer on the day, up more than 1%, were Dow Transports. Russell 2000 also posted a decent gain. You did not see healthcare participate in this rally, and of course, you take a look at some of the move in yields, that big move that we saw yesterday, 20-plus basis points on some of parts of the yield curve yesterday, being erased just a little bit, an uptick of about 7, 8, 9 basis points today, depending on what part of the curve you're looking at here. Also take a look at the dollar, because the dollar was a big story yesterday in some of the moves, and the direct correlations and the negative correlations that we have between the dollar, the yields, and what's going on in equity are probably going to become a much bigger part of this story. Remember, a lot of this rally is technically driven, and the technicals that we see here in the dollar space is going to be a big part of that. You're looking at the latest CFTC data showing that folks still long dollar despite the big downdraft that we had just yesterday. Also a big focus, of course, today on the retail space here. We got earnings out of Target and TJX. Those stocks moved in opposite directions. Tomorrow maybe provides a little bit more clarity about the health of the consumer. We're going to get Walmart and Macy's before the markets open tomorrow morning. And after the bell, we're going to get Ross Stores and Gap. Scarlet?
All right, and Romaine, we have some breaking news here. It's good news for Elon Musk and anyone who's looking to go to the moon and beyond, because the FAA has approved and reinstated SpaceX's Starship launch license. This is according to the agency. It's not immediately clear when SpaceX would conduct a launch from its site in Texas, but it has received approval to resume launches of the Starship rocket, and that ends an almost 7-month hiatus. And of course, this comes on the same day that there's been reports SpaceX is discussing an IPO for the fast-growing Starlink satellite business as late as 2024. So we'll continue to keep an eye on these developments for you. In the meantime, let's get back to the markets, because crypto may have topped headlines in 2022, but the talk these days on Wall Street is all about options. Retail investors flocking to them. And now the trading platform Moomoo is announcing a deal with the SIBO to offer index options trading on the Moomoo app. Joining us now from Chicago is Justin Zacks. He is Vice President of Strategy for Moomoo. Justin, talk a little bit about the demand that you've seen from retail investors for options, and in particular index options, since the pandemic that has created the need for this product.
Thank you very much for having me on the show. I really appreciate it. The demand continues to grow. A lot of people thought that this might be just a pandemic one-off, but I think people got introduced to options, a lot of new people during the pandemic, and they're more popular than ever. Overall volumes on all the major exchanges are at record highs this year. And then just on our platform, we've seen the users using options double just this year. Those are the equity options. So, we want to offer as many choices as possible to our users. And right now that includes equities and equity options, and most recently with this collaboration with the CBOE, we're now offering index options, and we want to do it in a way that makes it affordable to those users. So we're waiving platform fees for a limited time and charging 50 cents a contract for them to do so. And the real interest in the index options is you can't directly trade indexes. You can't trade the S&P 500 directly. So being able to trade options on these are great. And they also have a lot of great advantages, like cash settlement. You don't have to worry about being assigned an underlying, for instance, if you were working with commodities. And it also has favorable tax treatment, 60-40 tax treatment that includes 60% long-term capital gains for a lot of users.
Justin, I'm really interested in learning more about who the retail trader is who's dealing in options, and how that differs from the people who were zealously trading meme stocks during the pandemic, who are on those Reddit boards. Is it the same person, the same trader?
I think maybe there's a few of them. I mean, there's this image of these retail traders, that are super young and they're sitting in their mom's basement trading. And I'm sure there are a few of those, but our average trader is much older, into the closer to the late 30s, early 40s. They've been around trading a long time. They've been trading stocks for a long time, and a lot of them want to get into options. And so we're trying to educate them along with CBOE. We're having an event tomorrow at the old post office here in Chicago with the CBOE, where some of the CBOE's derivative experts will speak to some of our VIP users about how to use options, how to use index options in particular. These users are using these options for a variety of different strategies. It's not just this idea that we're going to get long calls and hope the market goes up. They're much more savvy, and they're using a lot of tools to get educated about how to use these options.
Well, that's what I'm curious about too, particularly as it dovetails with your platform here, because it did seem like when they kind of loosened the rules and allowed more of the retail set to participate in this, it really was just that. People either just going long a call or going long a put with no real understanding here of how to hedge those positions, or even just how to write options, if you will, as a way to maybe potentially make income here. Is all of that baked into the platform?
Yeah, and so what we're really trying to do with this platform is we want our users to make money. That's how we keep them, and to do that, options are complex product, and we really need to train them. And that includes educational videos and also paper trading. To me, that's the greatest way to get started trading anything, is to do it virtually. Do it with the fake money. It makes it much easier when you finally go to do it, that you've already done it virtually. And so to me, that's a way that we get there for a lot of our users, get them comfortable in understanding the risk. Because options, depending on the strategy, can be risky, but some strategies are much riskier. Like you said, those short naked calls could be much riskier than a covered call. So really explaining what the different strategies are to our users is so important, and then the users are able to use it in a much more responsible manner.
I am curious just about investor sentiment overall here. I mean, I know you guys have been conducting a lot of research into kind of the mood music, if you will, out there. When it comes to just all the volatility that we've seen this year and just some of the uncertainty around the economy here, has that actually sapped some of the optimism or at least some of the conviction that people have to even just be a participant in the market?
Well, I think it's two-sided. We do survey our users, and their number one worries are inflation in the economy. And we can see, I saw these numbers yesterday, and inflation's falling, but ask the average person on the street, they might not feel the same way. So it's sapping some of their psychology, but at the same time, they feel like investing is one of the ways that they can get out of this inflation trap, that if you continue to invest, continue to trade, it's a path to financial freedom.
What kind of turnover is there in trading these options? I mean, how do you see it picking up, especially as interest rate volatility increases?
Yeah, I mean, as the interest rates change, the trading's going to change, and so there is a lot of interest in the shorter dated options, and that's been the case for quite a long time. But there are people that now that are getting more interested in some longer dated options. It really depends on their strategy, and as they get more educated, I think they get a lot savvier with the strategies they're using in the type of trading. It's not necessarily just going to hold it for 10 minutes. They're going to get into a trade and a swing trade, and it's based on a number of fundamentals and technical analysis. It might be trading around earnings. There's lots of different strategies that now go into it.
All right, Justin, this was a great conversation here. Justin Zacks, he's the Vice President of Strategy over at Moomoo, options platform here for the retail set, joining us today from Chicago. Coming up here on the program, we're going to dive more into the results that we got just a few minutes ago, including out of Palo Alto Networks. Those shares down about 8% here in after-hours trading. This is Bloomberg. All right, keeping an eye right now on Palo Alto Networks. Shares of the cybersecurity company down about 8% here in after-hours trading. The company out with its earnings and a big miss here on some of the key metrics, including on its billings and lowering its outlook on a full-year basis. Mandeep Singh joining us right now. He's Senior Technology Analyst for us here at Bloomberg Intelligence. All right, let's get right down to it here. What is this about, Mandeep? Is this something very specific to Palo Alto Networks, or is there a broader trend afoot?
I think there is a broader trend here, and the reason I say that, in the print they call out variable contract lengths. That to me suggests that companies aren't looking to sign multi-year deals right now. Even though cybersecurity is an imperative, nobody wants to cut back, they're not looking to sign 3-year deals. Mm-hmm. And that is where they are calling deferred payment plans, et cetera. That's what shows up in the backlog number, the RPO number, that has decelerated, billings has decelerated. Even though it's a 100 to 200 basis point deceleration, it still goes to show the trend is that companies don't want to commit for 3 years right now.
But I'm curious about when they're not committing to 3 years, you say cybersecurity is important. I don't understand, what are they waiting for? Is the idea that they feel like they can get better pricing or just better services, or that they just don't need this at all?
Well, so you look at the hyperscaler approach here. Microsoft says we have a security co-pilot, and we can give you bundled security. That's when, as an enterprise, you have to ask yourself, am I better off consolidating everything with Microsoft? Again, you don't want to get logged in, but Microsoft is offering you this Copilot concept built on Gen AI, and they're giving you a cloud infrastructure. That's where the pure play security companies have a problem in terms of, one, showing their value proposition. And some of the cloud vendors like CrowdStrike and Zscaler have done that successfully. I think for companies that are moving from hardware to cloud, like Palo Alto, like Cisco, they have a hard time, justifying that.
Yeah.
So a lot of the decline that we're seeing today in Palo Alto Networks can be traced back to the fact that the stock has done incredibly well this year, right? Up about 84%. How much of this set of results, and we knew that there was going to be some disappointment given what Fortinet had told us, is really just pushback against, the stock has done so well, we already priced a lot of this in.
Yeah, so the multiples had doubled going into this year, and you're right, the stock had done extremely well, but look, at the end of the day, Palo Alto's strategy around growing that top line has been acquisition driven. They just acquired 2 more companies. They spent $1 billion, and they've been hugely successful in executing that. Unlike a lot of other companies that have struggled with M&A, security is a space where if you have a bundled value proposition, M&A really works, and Palo Alto has done that successfully. It's just the expectations probably got ahead of themselves, and that's where there was room for disappointment.
Anytime you look at these earnings statements from these cybersecurity companies, they talk a lot about next-gen software as opposed to firewall software. What is the distinction between the two, and which one brings in higher margins for them?
I mean, clearly, next-gen is all software. Firewalls, as we know, are appliance. They're hardware-based, and they had some supply chain issues earlier in the year, so that kind of created that backlog where they were able to fulfill it eventually, but we know hardware business is cyclical.
Yeah.
It goes through a refresh cycle. The same thing that applies to PCs and smartphones applies to firewalls. You don't refresh your firewalls every year. And that's where, they had strong product growth, but now it's still 30% of their business, and that product refresh cycle is fading. So they have to grow the next-gen business.
All right, Mandeep Singh covers all this for us at Bloomberg Intelligence. As our senior technology analyst, a closer look at Palo Alto Networks here, at least on the surface here, investors not liking what they saw out of the most recent quarter. Coming up here on the big program, we're going to talk a little bit more about what's been going on out there in San Francisco with the APEC conference underway out west. A big focus right now on one of the big shining cities in this country and, well, some of the slips that it's had over the last couple of years. Larry Baer is the president and CEO of the San Francisco Giants, and he's stopping by the program next. This is Bloomberg. Well, the S&P 500 on Tuesday made a run above 4,500, but it could not hold that level into the close, despite the monster gains that it had on the day. In fact, best day for the S&P going back to late April here. An extension of that rally today, and the extension was modest, only about 0.2%, but it did push the S&P back above that psychological level of 4,500. And right now, when you look at a lot of the technical levels on that indice, as well as some of its other indices like the NASDAQ, as well as the Dow, and even the Russell 2000 here, you are starting to see a long-term trend line unfold to the upside. That's a good thing for investors that have been betting on this for quite some time, and they are getting some aid here by what's been going on in the rates market and what's going on in the FX markets. That big downdraft that we saw in yields today clawed back just a bit today here, basically about 8 to 9 basis points higher on this day relative to the big drop that we saw yesterday here. But nevertheless, we are well below where we were just about a week or two ago here, and that seems to be providing some comfort, Scarlet, for investors going forward.
All right. We will, of course, continue to keep you up to date for any headlines that break on earnings as they cross. But in the meantime, we're looking at what's going on with APEC. The white hot spotlight is on San Francisco as the city by the Bay hosts prominent executives and world leaders for the APEC summit, including President Biden and Chinese President Xi Jinping. Of course, the city has seen better days. Remote work, homelessness, and rising costs are taking their toll. There is an effort underway to revitalize the San Francisco economy. For more on what one organization is doing for the city, we're joined by Larry Baer. He is co-chair of Advance SF. He's also president and CEO of the San Francisco Giants Baseball Club. Larry, it is good to speak with you. Thank you so much for joining us. I'd like for you to start off by first giving us a bit of a briefing on what Advance SF does, because it is a group of corporate leaders who are really trying to support revitalizing San Francisco's economy. Give us a sense of who's involved and some of the actual steps that have been taken.
Sure. Hi, Scarlet. It's great to be back with you. So Advanced SF was created really, several months ago to connect into the business community and make the statement that the narrative around San Francisco is just not, a lot of it is false, frankly, and overblown. San Francisco is a city of innovation. San Francisco is a city that is very resilient, has had setbacks before, whether it's been earthquakes or, or the economy, slumps in the economy. And what we're finding is while we do, like other cities, have issues with the unhoused and have issues with income inequality, there's a lot of vibrant activity going on in San Francisco, especially in the neighborhoods and especially in some of the areas around downtown. And we have companies that are completely leaning into that. Bob Fisher, founding family of The Gap, Chris Larson, who's a tech leader, Airbnb, Google. I mean, the companies that are based here really are in many ways leading the economy. Artificial intelligence here, this is really the hub of AI. And OpenAI just made a big commitment in downtown San Francisco. So there you see some of the companies. Visa has been a huge player in Advanced SF. They're building a new headquarters building in San Francisco. So a lot of what you read and hear about San Francisco is a narrative that is way overblown.
Right, but there are definite quality of life issues that can't be ignored. And I want to bring up something that San Francisco Mayor London Breed told our Ed Ludlow, especially when it comes to things like drugs, for instance. Take a listen.
Just to work with the U.S. and to ensure that the resources that are being sent out of China that come into either the U.S. or Mexico are cut off to the fullest extent possible, that we work together in order to ensure that this deadly poison that is killing people in San Francisco in significant numbers and all over the country, that we're able to combat this, to stop it.
And of course, she is referring to the inflow of illicit fentanyl to the U.S. from China, from Mexico. I mean, corporate determination is one thing, but you were also talking about law enforcement, not just locally, but federally and internationally, given the scale of the problem.
Yeah, no, absolutely. We're not saying there aren't problems. And law enforcement, in fact, fentanyl, which was a topic in today's summit meeting with President Biden and President Xi, is a huge issue here. In terms of enforcement and in terms of reinforcement through the state. Governor Newsom has, provided resources as well as the federal government. I think there's in the past, perhaps San Francisco has been looked at as a very permissive city, a very open city. And, the drug use has led to big problems. And I think what we're finding is, the federal, state, and local governments and police are enforcing in different ways now than we ever have. We have to also stop the flow at the source, right? And so fentanyl is a huge issue. It's really the number one issue in our community, as it is in other communities. But I believe, that the resources now are being devoted to it.
Larry, I'm curious as well, too. I mean, another big issue, at least for some of the folks that have left San Francisco for greener pastures, has been actually the cost of living. And I know that there have been some efforts here to address the housing issues there and to create some semblance of affordability that San Francisco has lost. But that is a long-term project, isn't it?
Yeah, I mean, more housing is absolutely critical. In the development we're doing by the ballpark, the Giants are doing by the ballpark with Tishman Speyer, 40% affordable housing. And in that, a lot of that is workforce housing. So we have housing at the lowest end, the economic scale, but all the way up so that we can have teachers and nurses and police and fire afford to live in San Francisco. So all the developers are really banding together to create more housing. It has to happen. It has to happen on the workforce level. It has to happen to be able to house the unhoused. And in San Francisco, some of it's going to have to be some of those scenes you're seeing there with the downtown office building. Parts of downtown are going to have to be over time converted from office to residential. Now, that's not going to happen overnight. But we have an issue with downtown being largely an office corridor. And we're going to have to find a way to create some housing, and there's some good ideas and some good movement toward that right now.
When you look at some of the other proposals that are out there have been some very prominent people that have tried to sort of propose their own solutions for San Francisco, and some of those have effectively been to kind of create their own pockets, if you will, economic pockets outside the city, housing pockets outside the city here. How do you feel about that?
Well, I think the city, I think you have to start with the city, right? Because the tax base, San Francisco is really the center of Northern California. I don't think you could say, well, it's fine, just everybody just moves out of San Francisco and, to kind of greener pastures, whether it's regionally or out of the state. The tax base is really generated from downtown San Francisco, the transportation networks. I mean, it all comes together. And so I think, it's a vibrant city. A lot of things are happening in the neighborhoods. So you're finding, there's an area called Hayes Valley that was really AI Gulch. A lot of the artificial intelligence companies were opening around there. So I think it's not necessarily everything happens downtown in terms of office development, but there are areas around the city that can continue to grow and can be reformatted. So we really don't agree with the narrative that, well, you have to go outside the city. I think what we're finding is that there's a narrative also in urban development of live, work, play, and those three being combined together. So it's, again, don't mean to say it's an overnight problem, but it is and you see on that chart,
right.
I mean, the AI companies are really doubling down in San Francisco.
Well, thank you for referencing our chart, Larry. Really appreciate your joining us today, giving us some context here about San Francisco. Larry Baer is co-chair of Advanced SF. He is also president and CEO of the San Francisco Giants. We've got more coming up on the close, more on the Biden-Xi meeting and what it means for U.S.-China relations. Mary Lovely, senior fellow at the Peterson Institute for International Economics, joins us next. This is The Close on Bloomberg. Earlier today, we saw the historic handshake as U.S. President Joe Biden and Chinese President Xi Jinping met in person for the first time in over a year. Xi called the U.S.-China relationship the most important bilateral relationship in the world. For his part, President Biden says we have to ensure that competition does not veer into conflict. Joining us now from San Francisco is Bob Moritz. He is global chairman at PwC International. Bob, of course, has been attending various meetings at APEC, I did not mean to say OPEC, including the global economy and the state of the world. And Bob, as you and your team meet up with others at this gathering, I'm curious how critical the U.S.-China relationship is to the stabilization of the global economy from where you sit.
Look, for each of the conversations we're having, no matter where they may be around the world, it's critical. This is a top 1 or 2 issue in every C-suite that we're talking to, regardless of what sector and what geographies they are. The people here clearly have a very keen focus. They're eager to hear what comes out of this, and there's a lot of anticipation of a positive sign. Those signs go to both reducing the stress that exists today between the countries, second, maybe some tactical actions that can be taken, and third, allow for the technocrats, those underneath our leadership teams from China and the U.S., actually to enable themselves to continue the dialogue after these meetings. And that's going to be really important because it's got to go to talk and continued talk thereafter.
So a lot of people say the fact that Xi and Biden are talking is victory in and of itself, even if nothing concrete actually comes out of it, even if the constraints and the restrictions remain. What does that mean for companies themselves and what they're able to do in terms of moving forward with being able to bridge whatever supply chain issues there had been between China and the U.S.?
Yeah, it's clear that when you look at supply chain discussions, CEOs, C-suites, and the management teams are looking at a combination of factors when they make those decisions. They're looking at the skills that are in the country. They're looking at the infrastructure that exists. They're looking at the relative scale of workers to be providing manufacturing or goods and services of some nature. But they're also looking for certainty. They're also looking for reduction of political risk and regulatory risk to make sure that they can not only make decisions today, but sustain them over time for resiliency. So what's coming out of the conversations is not only what's happening today, but what is anticipated to happen over the next 3 to 5 years as they make these supply chain decisions. That's why it's so critical for the talk to move beyond the rhetoric at a very high level to really say, okay, whatever was said today, is it actually being accomplished 6, 12, 18 months from now? Because we've seen these dialogues before. The world is worried about the volatile situation of talk and then no action. And that's the thing people are really focused on. So today will only be step one.
Yeah.
Step two will actually be the continuation thereafter.
We should point out here that the first session of that meeting between President Joe Biden and President Xi Jinping of China has officially ended. It ended about 5 minutes ago, Bob. Of course, there will be further discussions among them as well as among their deputies. I am curious, though, about the state of relations between the two largest economies and this idea that we keep hearing from, at least on the U.S. side, of not a decoupling, but the idea of some diversification of that relationship here. What do you think the future relationship will look like? Will it look like something that we had in the past, or will it be much more bifurcated?
Look, I think you're going to see a combination of things. First, let's recognize the realities that the trade, the investment amongst the two countries is important both to those two countries and their domestic agenda as much as it is to the entirety of the world. So you got to maintain that at an appropriate level. Second, you are going to see people take a look at my historical critical key dependency on China from a supply chain perspective and say, should I take a look at other options? Again, they're going to come back to some basic decisions. Are the economics right? Is the resiliency there? Do I have the stability I want? And equally important these days, is it green? And can it give me the data I need to manage with the agility because the world's moving way too fast? If China can commit and continue to do that, they will have that opportunity to continue the supply chains. But the reality is that future is going to be changed. The global economy and the global capitalism that we've seen is definitely not dead. Many people have said that. I'm going to say it needs to be rewired. You're going to see a lot of bilateral regional relationships, but the critical dependency between the two countries, that's going to remain for a very, very long period of time.
Well, I am curious. It's interesting you use the word rewired because, of course, that's been a big topic of conversation as to whether globalization as we know it is effectively over. And we'd be remiss in not pointing out a lot has been made about Xi Jinping's trip here to the U.S. This week here, particularly, though, against the backdrop of what we saw, I don't know, 4 or 5 months ago when Prime Minister Modi from India arrived with a tremendous amount of fanfare. And it was not lost on anybody that a big part of the reason why everybody here in the U.S. was sucking up to him was because they wanted an alternative to China.
Look, the reality is India and what it's done over the last 10 years ago or so is definitely now a more viable opportunity than it ever was before. Modi himself has created some policies in terms of enhancing the infrastructure. They're moving with the speed and scale to be a credible alternative. And again, it's going to be a very competitive world between India and China, and for that matter, many other countries that are here today represented at the APEC session. You've got places like the Philippines, Vietnam, Malaysia, Indonesia, equally as important. Everybody's going to be competing more so to give themselves some multiple alternatives. The two things I'll say, though, is many believe that supply chains are being home-shored. We don't see the evidence of that. We actually see them looking at multiple alternatives. You may see some near-shoring, a little bit more so in the past, but it doesn't mean it's always brought to the home front. Second, when you look at the U.S., they've done a lot now with the Inflation Reduction Act to actually incent more production here. So that's going to be another element in terms of what countries do to incent the right behaviors and the economics behind it.
All right, Bob, I really appreciate you taking time out of your day there. I know you've been busy out there at the APEC Summit, global chairman there over at PwC International. And we continued the conversation here about the relations between the U.S. and China, and who better to talk to than Mary Lovely, senior fellow at the Peterson Institute for International Economics. And Mary, I just want to get right to it here. Are you expecting we're going to see any sort of material change in that relationship as a result of the meeting today?
I think as the chairman from PwC just said, we're looking for some signs that not only that the tenor has changed, but that this time it's going to stick a bit. So it's not just the US and China, as you mentioned, it's the rest of the world, it's the rest of the Asia Pacific, it's Mexico. Everyone's looking at this relationship right now, and they want to see the signs that it will stick. It has to come from a determination at the top that there is an ability to put a floor under the relationship.
Yeah, and I'm curious too about the setting. I mean, we talk about, they're meeting out kind of outside San Francisco at Filioli, which I was told is, I'd never been there, but I was told that it's been used a lot. It was a set for Dynasty and something else there. But I'm always curious about the choices of where they choose to meet, because they could have easily just done this near the convention center there in downtown San Francisco here. But to go outside of the city like that and go to, I guess, what ends up being a bit more of an intimate setting, why?
The Chinese were very sensitive to the way that President Xi was going to be treated. They wanted this to be treated as a summit, not just a side meeting. And so the fact that it is off-site, the fact that there's a official greeting of President Xi by President Biden, these are important signs to the Chinese of the respect that they feel that they are due. So I think you're right, Romaine, to look at the setting. I think it's telling us that the Chinese want to be treated with a certain level of respect and peer status to the United States.
And one thing, of course, that they'll be discussing is the status of Taiwan. We know China believes in the one China principle. Taiwan's current president does not. Xi Jinping has made no secret of the fact that he wants unification at some point with Taiwan. Mary, how far is the White House willing to go in reassuring Beijing on its stance on Taiwan independence, opposing versus not supporting, a lot of that rhetoric, for instance?
Yeah, honestly, I don't know how far they're going to go. And I don't think we're going to see any specific language in the readouts. President Biden himself has been a bit, let's just say, ambiguous, even going so far at one point to say that we would, of course, defend Taiwan if they were invaded. And then, you know, the White House saying, no, here's what he meant. It's a one China policy. It's the same we always had. So I think that when we talk about a floor under the relationship, we definitely mean a floor on the security and military side. We definitely want to see some commitment to deeper communication on the military and security levels, as well as a floor in the commercial relationship. And Taiwan is definitely the #1 issue for the Chinese on the military side, security side.
Yeah, especially as Taiwan's opposition parties team up perhaps for a joint bid to challenge the ruling DPP. Mary, this will likely be the last Biden-Xi meeting before the 2024 presidential election here in the U.S. Does that create more or less urgency to come up with concrete, actionable items to stabilize this important relationship?
I think we have seen the Biden administration progressively putting more resources into stabilizing the relationship. It was repeated speeches by Secretary of the Treasury Yellen, as well as visits to Beijing by Secretary Blinken, Secretary Romano. So this has been an important activity for the Biden administration this year. I think it's not necessarily the election pressures. I think it's the deepening of their understanding of what needs to be done in the Indo-Pacific. We have at the same time as this APEC meeting, a rollout of where we're going to, where we are with the Indo-Pacific Economic Framework negotiations that are going on with other countries in the region. So far we have no agreement on the trade pillar of that relationship. And I think one reason is that many countries in the region are reluctant to sign on with the U.S. when they don't know what the U.S. opinion or attitude is going to be toward Chinese content in their exports.
Yeah.
So for them, this relationship is extremely important and goes to other activities, other goals of the Biden administration that have been on the agenda the entire year. So I don't think it's just election pressures.
All right, Mary, going to have to leave it there. And I guess it's a good idea that they are meeting. And we should point out there was a lot of groundwork before this year. So a lot of communication taking place right now between these two countries, communication that, let's just be clear, wasn't taking place about a year and a half or so ago. Mary Lovely, Senior Fellow over at the Peterson Institute, a closer look at that APEC summit. When we come back after the break, a closer look at what financial markets have their eye on tomorrow. This is Bloomberg. A lot for markets to chew on Thursday, including quite a few earnings. Alibaba, Walmart, Macy's, and Gap among the ones we're looking for.
A close look at the consumer, what they're doing. And of course, the economic data continues, jobless claims and industrial production.
And we're also going to get more Fed speak, which I know you love. Loretta Mester, Williams, Barr, Cook, among some of the names we're watching.
And APEC continues. Of course, we did have Xi and Biden meeting today. What happens next?
And Starbucks workers at some of their unionized locations planning a one-day strike tomorrow.
Yeah.
This is Bloomberg.